Welcome everyone to Bombardier's 2011 Investor Day. Thank you for coming, and so many people accepted the invitation. We're very happy you're here. So for those of you joining us via the webcast, this information session is presented live in its integral version, and you will also be able to ask your questions via the webcast. You just need to type in your email address and question, which I will read out loud. And whoever it's addressed to, specify who you're addressing it to, and the person will answer it live. So during the question period, I will alternate between the room and the webcast to make sure that all your questions get answered. And for those in the room, please wait for the microphone before starting to ask your questions so that the video webcast can capture it. And the video webcast archive should be available within the next 48 hours in its integral version, as well as the presentations that you will be seeing today. The French versions of these presentations will need to be translated, so they will be posted on the website as soon as they're translated. This morning we have with us Mr. Pierre Beaudoin, President and Chief Executive Officer of Bombardier Inc. We have Mr. Pierre Allery, Senior Vice President and Chief Financial Officer of Bombardier Inc. Mr. André Navarry, President and Chief Operating Officer of Bombardier Transportation, and Mr. Guy Haché, President and Chief Operating Officer of Bombardier Aerospace. We also have other members of the senior management team with us in the room, and you'll have the opportunity to meet many of them during the lunch. And we also have others from Bombardier who helped us to organize this event, and I wish to thank them all for their help. And they will be here also to assist you if ever you need anything. So in an effort to stay on schedule, we'd ask you to keep the question period for after Pierre Allery, after Guy Haché, after André Navarry, after Guy Haché, and then Pierre Beaudoin will be coming back to conclude, and we'll take a question period for Pierre if you have any left by then. So we'll repeat this format at the end of each of the presentations. So again, at that time, we'll be alternating between the webcast and the room. And please try to keep your questions to one, with maybe one sub-question. That would help. And before I hand over the podium to Pierre Beaudoin, I will be going through the forward-looking statement because we have Danielle listening in. So I wish to remind you that during the course of this information session, we may make projections and other forward-looking statements regarding future events of the future financial performance of the corporation. Several assumptions were made by Bombardier in preparing these statements, and we wish to emphasize that there are risks that the actual events or results may differ materially from these statements. For additional information on such assumptions, please refer to our last annual report. And I'm also making this cautionary statement on behalf of each speaker whose remarks today will contain some forward-looking statements. And as usual, all dollar values are expressed during this presentation in US dollars, unless stated otherwise. And I will also want to remind you to please turn off your cell phones for the duration of the presentations. So without further delay, let me turn the podium over to Pierre Beaudoin.
Good morning. Let me say it's a pleasure to be here this morning. And what I'd like to first do is remind you of the results that, I won't do this again, remind you of where we are so far this year. I understand with most of you we've done a Q3 call last week. But I think to understand, and today the goal is really to talk about Bombardier looking forward. But I think to set ourselves in the reality of today, it's important to start with where we are today. So if we look at aerospace, so far this year we've achieved a 5.7% EBIT margin, which I think in the economic context that we're in for aerospace, given that we're delivering, as you know, 240 units this year, that's our forecast for the full year. I think those are good results. If I compare with our peak delivery of 2009, where we were at fiscal 2009, we got to get used to this. Now we're going to talk calendar year. We were at 360 units. You can see that we've had to deal with a lot of variation in volume. And of course, that means we were very good at adjusting our costs, increasing our efficiency, and delivering 5.7%. Our cash flow from operation is good, but at the same time, as you know, we're investing heavily in new product, which when I come back at the conclusion, I'll show you the volume potential we expect, at least target for these products. But right now, it's investment time, so it means a lot of tooling investment, a lot of R&D. So from a net perspective, if you look at Q3, we're basically break even with our cash flow at a 53 million positive. If you look at this year, although growth is not there as we would have expected in business aircraft so far, a little bit challenging in commercial, and Guy will cover that. We still have a 15% year-to-date revenue growth with a solid backlog, a growing backlog at 22 billion. Quick look at transport, 7.2% year-to-date, on our way to our target of 8% for 2013. Free cash flow more challenging this year than we had expected, and André will cover that in more detail. But like I said last week, it's essentially related to 3 large projects that we are dealing with. All of them right now are back at last week I said that we're delivering, for the most part, we're back in the delivery phase with these products. I can say that right now we're delivering the 3 products. Now, this will not come back overnight. When you face a challenge like this, you've got to make sure you've balanced your schedule with what the customer can take and can put in function by training the drivers and making sure the operations are in place. But the products are back in the delivery phase, and that's a good news. And also this year we were affected by a hedging mechanism that we do when we take a contract. We want to ensure the margin for the company, and we hedge our contract, and that will have a cash flow influence through the years. And I'm sure if you have more question on that, Pierre can explain that in more detail. But this year there was a wider variation than usual as we're doing a product in Switzerland. And most of the costs would be in euro on this product, and it's a variation between the two. But still in transport, we're seeing some revenue growth, 6%. If you ignore the exchange rate, which I think is quite good. We're very close to a book-to-bill of 1. We're at 0.9. Whether we'll achieve 1 for the year, that's our target, and we'll see. We have good plans for Q4. But if you take this in the context that we did 1.6 last year, I think we're in very good shape, and we have a backlog of 33 billion, which is very, very strong. Now, if we look in terms of EPS, 42 cents last year, we already have achieved 35 cents so far this year. So I think we're well positioned to show good profitability in what I consider still some economic challenging time. And if you look from a profitability perspective, I think you know the story of our company. Transport has been increasing profitability since the break-even year of fiscal 2005, on our way to 8%, and we feel with the backlog we have good visibility on our revenue, because a lot of you, I'm sure, will challenge us on what's going on in Europe, but we have good visibility on our revenue given our backlog. And of course, when you have a backlog, you also have good visibility on your margins. So we feel that we're well positioned to achieve our target. And from an aerospace perspective, since fiscal 2009 or 2008 calendar year, we've been well positioned. We've been delivering good results in a situation where the volume has been coming down. And what I like when I see those results, it means that we keep improving our efficiency. We keep making sure that we get better from an execution perspective, and Guy will cover some of that. But that means that we're ready when volume comes back, and this company can produce great results in the future. So we're positioned well for the recovery. So my last slide before I let André come up is really when you think of Bombardier, there's really 3 strategies you should think about. What are the strategies this company focuses on? First of all is investing in leading mobility solution, new products that will permit us to continue to be a leader in our markets. Whether it's a geographic expansion for new product or it's game-changing product, that's what you should think about when you think about Bombardier. Grow a local, or the second one is grow our local roots in key market. And what does that mean is that as a Canadian company, given that our market in Canada is quite small, we've developed the ability to become local, to be successful. So as a good example, I think would be Germany, where our head office of transport is in Berlin. And in Germany, we're often thought about as a German company. But we try to do that in every country that we have sales. We do well in France because we focus on the fact that we have large operation in France. But today you should think about us in emerging countries doing the same thing. We were the first one to get established in India with a metro factory. And maybe we could have got away with a Delhi contract without doing a factory in India. But the idea is this is going to be a very large market for metros, for locomotives, for all kinds of transit equipment. And if we want to be successful, our recipe is to become local. And now we're learning how to do business in India. The same thing we did in China 15 years ago. And today, we're the only established player in mass transit in China and having some success. So think about us as developing our local roots and developing market. And the third point would be flawless execution. We often get told, is execution really a strategy? Because that's what you have to do every day. But I think if you're a manufacturer that builds complex product like us, it has to be a strategy in the sense that that's the focus of the company. And we know that if we execute well, we'll satisfy our customer and we'll increase our margin year after year. And we can deal better with fluctuation in volume. So these are the three strategies that as you go through the presentations of Pierre, André, and Guy, think about those three strategies. And at the end, I'll come back and kind of show you how we feel these strategies will deliver additional revenues to Bombardier and additional margin. So on this, I'll turn it over to Pierre.
Good morning. So it's a pleasure to be here today and to cover some of the subject that I'd like to review with you. First of all, the change in year-end. We've talked about it, but just to make some confirmation. Then I'd like to cover the drivers and the trend in our free cash flow, our liquidity level, and the renewal of our credit facilities, which took place in the second quarter. Then I'd like to review the evolution of the retirement benefit liability, and again, the drivers behind it, and also a quick look at our global matrix review. So starting with a change in year-end, we mentioned at the beginning of the year that we intended to ask the board to change our year-end. Well, effectively last week, the board did approve the change in year-end, effective this December. So that means that our year-end will be December 31st of this month. And it has no impact on Bombardier Transportation, as BT is already on a calendar basis, so we were already consolidated with a month lag, so there's no change on that side. On the other side, though, on the aerospace, we're only going to have 2 months worth of operation in the fourth quarter of this year, so 11 months for the full year. And you can see the expected issuance date in terms of our next quarterly result coming up next year. Now, let's move to the free cash flow, and let's start with the transportation. So this table presents the reconciliation of EBIT to free cash flow for the past 5 years, and also for the first 3 quarters of 2011. So it should be noted, though, that the first 4 years are prepared under Canadian GAAP. The fiscal 11 and the year-to-date are prepared under IFRS, but the change with respect to Canadian GAAP versus IFRS in relation to free cash flow is very minimal at the end, so therefore it doesn't, the comparability, it doesn't really impact the comparability. So within transportation, the level of free cash flow may vary significantly from quarter to quarter, depending on the specific cash profile of our numerous contracts And this is reflected on the fifth line, the net change in non-cash balance, where we see the fluctuation going. And if we look at the first 3 quarters of this year, we can see that we experience a free cash flow usage, which I would qualify as exceptionally high. And it is mainly due to a number of things. First of all, an increase in inventory due to the ramp-up of several contracts ahead of deliveries. So that's a normal fluctuation that we see depending on our contract. But also, as Pierre referred to, due to delay experience and delivery of some rolling stock contract. And we've discussed those already. Pierre referred to it. There's 3 contracts, the SNCF contract. There's the Talent 2 contract in Germany, and also our contract, the Regina contract in Sweden. And in all cases, we've resumed very recently deliveries. So therefore, we expect the inventory to decrease gradually over the next few quarters. So it's going to take a number of quarters before we actually see the cash flow really coming back. We expect a good free cash flow for the fourth quarter, although not sufficient to reverse the entire free cash flow usage that we've experienced since the beginning of the year. The other element that impacted the free cash flow and transportation for the first 3 quarters, and it's the first time that it has such a significant impact, is the settlement of derivative financial instrument used and roll forward cash flow hedge. And these amount since the beginning of the year to approximately 300 million. And to illustrate it, I've prepared a simplified example. And if we look at the assumption in my example, is we have 100% of the inflows from a customer that are in Swiss franc. So we basically have a contract in Switzerland, we're being paid in Swiss franc. And as part of the contract, some of the payment to supplier, let's say amounting to 100 million euro, are scheduled to take place in the second year of the contract. So we do the engineering first, and then we start buying the material, let's say, in the second year. So at the beginning of the contract, we hedge ourselves. So we take a forward hedge to sell Swiss franc that we receive from our customer and buy euro in order to be able to pay our suppliers. And let's say that the exchange rate at that point in time is 139. So we contract, and it's a year term, our hedge, because the hedge doesn't necessarily match the exact duration of the underlying. And let's say the exchange rate is 125 after a year, and then 129 after the second year. Now let's see what, in terms of cash flow, what happens. Well, first of all, at inception of the contract, there's no cash flow, so there's no impact. Then at the end of the first year, the hedges roll over, and as the euro, in my example, lost 14 cents vis-a-vis the Swiss franc, I have to settle with the counterparty being the financial institution. So make a payment of 14 million. At the end of the second year, the hedge matures, because we take another hedge basically at the end of the first year, so at the end of the second year when the hedge matures, and then the exchange rate is now 129. Then compared to 125 the year before, that means that we get a payment from the financial institution back to us of 4 million in this case. And in order to be able to pay my supplier, I use 129 million of Swiss franc spot, which I use to buy 100 million euro and then pay my suppliers. So the total cash outflow amount to 139 million, being the 10 million net to the financial institution, 14 million the first year, 4 million back the second year, and then the 129 million that I use to pay in fact, to buy euro to be able to pay my supplier for 100 million. So the total outflow, being equal to 139, is basically equivalent to the 100 million euro at the hedge rate being 139. So that means that over the life of the contract, my cash outflow is exactly in line with my hedge, and it's exactly in line with our expected costs, total costs over the contract. So basically, it means that the payment we've made of 300 million since the beginning of the year essentially will be recovered through the life of the contract. Obviously, we cannot predict when, because it depends on how the foreign exchange move and until we made the effective payment to the suppliers. But it's it clearly demonstrates that it's coming back. So the 300 million it will come back effectively. Now, you've often hear me saying that the free cash flow in transportation is aligned with profitability over time, and that's what this graph demonstrates. If you look at the blue bar, this is the EBIT for each of the past 5 years. The light blue bar is the free cash flow, and the green line is the net of the two on a cumulative basis. So you can see that after 5 years, the difference between the cumulative EBIT, which is about 2.4 billion, versus the free cash flow, is only 123 million. So basically aligned, and that's what we see in transportation. Now, if we move to aerospace, in the case of aerospace, the cycle is much longer. In transportation, we have contract 3-5 years, and transportation is more 20-25 years with the cycle of our development and selling of our product. So the aerospace free cash flow is more dramatically affected by the business environment in which we're in, and also by the level of investment in our product. And what I mean by the business environment, you can look at the third year, fiscal 09, and you can see the net change in non-cash balance, the fourth line, where we have an impact negative of about 900 million, and that's the actual. And basically what happened is at the end of fiscal 09, and you remember the financial crisis was the end of 2008, so basically we started getting cancellation from our customers, and we ended up the year with 35 more aircraft than what we had anticipated to have in inventory. So resulting in a 600-700 million more inventory. So you can see the impact here on the net change in non-cash balance. And then at the beginning of the following year, we adjusted our production rate and therefore been able to sell the aircraft that was in excess at the beginning of the year. And that's when we see in fiscal 10 and fiscal 11, the positive being basically the inventory coming down as we have sold the excess inventory of fiscal 09. Another element, again, with respect to the business environment in aerospace, if we look at fiscal 08, we had a record year in terms of new orders in business aircraft, and therefore have a lot of advances from customers. This is the fifth line in fiscal 08. So the free cash flow benefited from the fact that we've increased significantly our backlog, and it's reflected here by having 1 billion additional. But if you look in fiscal 10, that's the year where, following the crisis, the financial crisis, where our deliveries, we continued to deliver the aircraft, but we didn't sign any new orders or very low net new orders, and as a result, we depleted the backlog and therefore reduced the level of advances. And in fact, on this graph, the following graph, we can see the correlation between the advances and the backlog. And we can see that when the book-to-bill is above 1, which is the green line, so we can see in fiscal 08 the book-to-bill was 1.9, and we can see that the change in the level of advances was positive 1 billion. And then in fiscal 10, the opposite happened. We had a book-to-bill of basically flat, and we continued to deliver, so therefore we depleted the backlog and depleted the advances by 900 million. And when the book-to-bill is 1-to-1, roughly, if we look at the first 3 quarters of this year, at 1.1, we're basically, the cash flow is basically neutral or close to neutral with respect to the advances. Now, the other component that affect the aerospace free cash flow is the level of investment in our product. And on this graph here on page 11, we're showing the cash flow generated from operation, being the dark blue bar. Then the light blue is the investment in our various program, and the green line is being the free cash flow, basically the net of the two. So we can see that in the up to fiscal 11, and if we were to normalize for the excess inventory that we had in fiscal 09 that we recover, so I remove both positive and negative, and also on the advances that was exceptionally high in fiscal 08 that we kind of reduce in fiscal 10. So if we were to normalize those, we would have had $1 billion plus of free cash flow generated from operation in each of the past 5 years, basically. And we expect that billion-plus level in terms of free cash flow to continue to increase with the volume and also with the increase in demand over the next few years as we see the recovery. So basically, our approach is to fund our significant investment in aerospace with the cash flow from operation. Now, if we move to the liquidity and the renewal of our credit facility, so we took advantage of the favorable condition at the beginning of the year to renew our various credit facilities. And this was, in fact, concluded at the end of Q2 at improved terms and conditions with essentially the same financial covenant that we had before. And we took the opportunity to increase our line of credit from $500 to $750 million. And also, we've been able to free up our invested collateral to increase our level of liquidity. And in fact, the renewal of these credit facility and the liability management exercise that we did last year, whereby we basically issue $2.6 billion of long-term debt in fiscal 10 to buy back $2.1 billion of long-term debt. So we basically push the term of those debt to the right. So that's giving us or ensuring us that we have the liquidity level and the maturity profile that does permit continued investment in our new product development. And if we look at the liquidity level at the end of the third quarter at $3.5 billion, and we anticipate a Q4 free cash flow to be positive, so therefore we expect to conclude the year with liquidity above $4 billion. Now let's look at the retirement benefit liability, which is a bit of a change compared to under Canadian GAAP versus IFRS. Not as much the amount, but we're adding up the OPEB, and it's now on balance sheet. So what we see is that there's three components in the retirement benefit liabilities. The first one is the funded pension, which amount to $1 billion at the beginning of the year. Then we have the unfunded pension, mostly our European pension, which have a deficit equal to its benefit liabilities, as there's no asset set aside, so that's unfunded, and also the OPEB that is also unfunded. And in each of those two cases, it's basically pay as you go. So what this graph is showing is that the increase in net retirement benefit liabilities is essentially due to lower discount rate. And since the bulk of the variation comes from the funded pension, let's review it more specifically, the funded pension. So basically, the funded pension went from $1 billion at the beginning of the year to $1.9 billion at the end of the third quarter, essentially again due to discount rate assumption. And the discount rate we've used is basically prescribed. It has to be a high quality corporate bond, and we use it in the respective countries. So we can see that we use September 30th and October 31st being the measurement date for BT and BA respectively. So since we're changing the year end, it's all going to be December 31st at the end of this year. And you can see the variation in the rate going for Canada, 5.20. That was at the beginning of the year for transportation. That went down to 4.62. So quite a variation, and that has impacted that is the discount rate that impacted the liability, and which made the liability increase. If you were to look at the past 2 years, the same thing happened. The first 3 quarters, the discount rate went down, so therefore the liability went up, and then it turned around in the fourth quarter. Last year, the change in discount rate was $1.1 billion compared to that $800 million this year. Mind you, the story doesn't tell us what's going to happen, in fact, at the end of this month. So, when you look at pension, the discount rate, if the change are due to the discount rate, you have to look at the discount rate being used. And the question is it the lowest point? Are these low level sustainable? What's going to happen? In fact, we'll know, on December 31st or soon after, what's going to be the actual rate to calculate what's going to be the accounting deficit at year-end and also the funding deficit. But in fact, when you look at pension again, what's critical is the amount that is contributed, and what we just saw is the accounting deficit. But what drives the pension contribution is the funding deficit that is calculated using different rates, which varies from country to countries, and there's regulation in each of the countries and so on. But if we look at what happened the past 4 years, total contribution has been just short of 400 million, which has been, this year contribution are expected to be just short of 400 million, which has been the level of this similar level over the past few years. And in fact, we've made some calculation of what would be next year contribution using the discount rate at the end of the third quarter, and taking into account the relief measures announced recently. And based on these calculations, we estimate that the contribution for next year would be at the same amount as this year if the discount rate doesn't move. And hopefully it's going to go up, so therefore liability down. Now let's move to the global matrix. And the first matrix we track is the interest coverage, which is the calculation of the adjusted EBIT on the adjusted net interest. And the adjustment we're making are described in our MD&A, and I'll skip it for the time being, but they're fully described in the MD&A. And our objective is to have a ratio greater than 5, which is essentially consistent with an investment grade profile. And we can see that we've reached, or we've just passed the 5 bar at the end of the second quarter. So basically, when we look at the ratio, the adjusted EBIT has improved over time, and the adjusted net interest has been stable, so therefore an improvement in the ratio. The second ratio is the financial leverage, but before looking specifically at the ratio, let's review the component of the adjusted debt, because there's quite a number of elements that comes into play. First of all, there's the long-term debt, as reported in the financial statement, and the long-term debt, as reported in the financial statement, reflects the foreign exchange and interest rates movement. So you can see that although the face value of the debt has not changed, the value we report is effectively changing. On the other side, though, we have some cross-currency interest rate swaps that we have in place, which move contrary to the movement of the long-term debt. And it's effectively, we're hedging some of the interest rate, so therefore we have to take into account those adjustment for hedging derivative that is basically that balance that fluctuation. So we can see that when we put one against the other one, and the hedging derivative are on the asset side, so when we put it once again the other one, the adjusted long-term debt has been very stable, which has been the case since the beginning of the year. We then have the net retirement benefit liability, which I went through just before. So it has essentially increased due to discount rate. We take into account the sales and leaseback facility that we have to finance some pre-owned aircraft, and that came down during the year. And we take the net present value of operating leases, which has been stable. So we see that the adjusted debt, total adjusted debt, has increased essentially again due to the net retirement benefit liability. So now let's review the financial leverage in itself, which is the adjusted debt on adjusted EBITDA. So the ratio has deteriorated due to the fact that the adjusted debt has increased, again, due to the net retirement benefit liability, while on the other side, the adjusted EBITDA has improved, so somewhat offsetting a portion of that variability. So we can see that the ratio is now above 4, and our objective is to have a ratio around 2.5. And obviously, there's two ways to improve the ratio: reducing the debt, so working on the net retirement benefit liabilities, and improving profitability. And we obviously are very focused on working on both of these aspects. So overall, we continue to focus on cash generation to fund our significant investment program, and we have a strong liquidity position that enables us to effectively continue to invest in our product.
Thank you, Gab. I forgot to mention that the media are also invited to join us via a webcast, and we will be taking questions after each presentation from the media as well. So we're now ready to start our question period. If you have any questions, please wait for the microphone. We have 4 people assigned to give you the microphones. David.
Hello.
The microphone should work. Is it okay?
Is it working?
Yes.
Okay. David Tarman, Canaccord Genuity. Pierre, just to the question on BT non-cash working capital, obviously a very big negative this year, 1.5 billion negative. Would you expect that to reverse completely over time? And if so, what sort of time frame would you expect it to reverse over?
Yes, we do. Well, we expect the bulk of it to reverse. And it's a bit difficult to predict as to the timing because it's in relation to the specific contract. So on the delivery, we've referred to some of the contract that's going to be over several quarters. And on the hedging aspect, that could take up to 4 or 5 years because that's how long our contract is going in Switzerland. But it could reverse effectively next quarter, depending on the exchange rate. If the exchange rates come back to the rate that we had when we contracted the hedge, then basically we're going to be going to get the cash all back at once. So it's very, very hard to predict. The only certainty is that we're going to get it back.
Okay, and just related to that then, sort of a sub-question. So where does that, it sounds like that hedge is in the BT non-cash working capital. Where is it that I would see that change?
You would see the change, it's part of the other financial liabilities or asset, depending on which way it's going, liabilities, yeah.
Thank you.
But it's effectively the cash out. We make a payment. So.
David Newman, Cormark Securities. If I look at the sort of weighted average advances on the BA side and on the BT side, what is the wishful thinking, but if I could go by a global today, what is sort of the timing that we could expect that to come in? And what is the actual final true-up, I guess, from between advances and the actual sale amount? And what is the timing on that?
In terms of the advances?
Yeah, so you get, let's say, on a global 15% down,
yeah.
And then you kind of move to the program. So how do the advances get trued up, and what are the different milestone payments, and what's the final true-up, I guess, through time?
Well, it's gradual over time.
Right.
And it's basically at inception. We don't specify the amounts. It depends on the program. It depends on the given situation and so on. But typically, you would have a milestone at signature, and then at a period in time, like 18 months prior to delivery, 12 months prior to delivery, at the green stage. So there's a number of steps, if you like, or milestone.
What is the final payment amount? Like have you collected, let's say, 75, 80% of the value of the aircraft, and you're getting a final 20% as a true-up?
That would be typically the amount, yeah.
Okay. And on the BT side, is that dramatically different?
The BT side, again, will vary a lot from contract to contract, both at inception and the milestone varies a lot. In some contract, we're up to a point where we have, let's say, 60% level of advances, and some when we deliver the final or when we deliver the train. In some other cases, it's higher. In some other cases, it's lower. It varies a lot. It's basically contract to contract. And when we do the bid, we take into consideration the cash flow profile in terms of the pricing and so on.
Joe? Yeah, Joe.
Thanks. Good morning. On the transportation, the contracts that have been delayed, you explained that that's going to come in over the next several quarters. I guess my question is, how are you, from a risk standpoint, evaluating your profit on these, and how comfortable are you that you might find out 3-6 months down the road that as we've seen in the distant past in this business, if you go back to 03, 04, 05, the same thing happened. We had poor cash, and then all of a sudden you had significant negative profit revisions. How comfortable are you that your estimates are going to hold?
Well, first of all, we do review our various contracts on a quarterly basis. So in terms of the profitability, in terms of the cost to come, and we do adjust as we go along. Obviously, when we face issues with delivering of a contract, we do incur additional costs. We take those into consideration, what needs to be spent to fix whatever needs to be fixed, and then that is accounted for and adjusted on a cumulative catch-up basis on a quarter-by-quarter basis. So it is review, and it is revised in terms of our latest analysis of contract to come. When you look at a contract, at inception, everything is an estimate. And as you start doing the engineering, you're progressing, and then when you start delivering, that's where you're getting the closest to the clearly knowing your costs. So the uncertainty level as you approach delivery is reducing a lot. So in fact, today, we're in a much better position to say these are our costs. This is our production costs because we've produced some, we've delivered some, so we know the actual costs. We know the learning where we're at the learning curve and so on. So it's much more precise than it would have been like 9 months ago on the same contract, for example.
Is there a substantial amount of rework that has to be done on the inventory trains to bring them up to the delivery spec?
What needs to be done has been accounted for and estimated, and that's the level of disclosure we're giving.
Okay.
But it is it is
Part of the margin.
it is included. It is the costs are adjusted, and our margin going forward has been adjusted, and the catch-up adjustment has been reflected.
Okay. And then just on the Forex hedge, why is it that this is the year that this is significantly larger? Is it because you had a big book to build?
It is significantly larger because we had a significant contract in Switzerland. In fact, those variations are mostly with the Swiss franc. And typically, where we do produce the car and where we do sell the car, that's where we have the bulk of the cost. Mm-hmm. Like if we're in Germany, it's mostly euro, and we might have some FX from different non-euro zone, but it's relatively minor. In the case of Switzerland, it's the other way around. So 100% of our revenue are Swiss franc, and a good portion is euro. So therefore, the face value, if you like, of our hedge is much more significant. And the other currency, it's much more balanced. We're selling and buying at different point in time, so they kind of offset each other. So that is very particular.
It has very little to do with the intervention of the Swiss government in the Swiss franc.
And in fact, the currency moved significantly, and because it moved significantly, it had an impact on us. Mm-hmm. And the government reacted not to the impact on us, but the impact it has on Switzerland. And it's not related. In fact, what they're doing is they pegged the currency, and that should, in fact, help us to reduce volatility.
Thank you.
Marco Pensac, GMP Securities. At your accounting seminar back, I guess, beginning of this year, you talked about the change in accounting for the depreciation or the amortization of program tooling costs in the C-Series. In that amount, can you share with us how are vendor financings and support treated, and how is government finance treated? And just for modeling purposes, like what's, as you sit here today based on your assumptions of the cost of the program, what's that actual dollar amount that you're actually going to be amortizing?
You mean the amount we receive as support?
Well, what I'm not clear on is, do you net out government support or vendor support from the total spend on the program for amortization of program tooling? Because there's a bit of a...
The answer is no. Under IFRS, we do set it up as a liability. And so it's a liability that is set up. So therefore, when we reimburse on a fixed amount per aircraft, it's going to reduce the liability. So on the other side, there's an interest component that we calculate every month that is reflected as part of the net interest.
Okay, thank you.
Tim? Noah.
Just following on Joe's question, which led to margins, is there any change in your thinking, or should there be any change in our thinking regarding your longer-term margin projections in both segments? It's obviously very volume dependent on the aerospace side, and you guys have made volume reductions since you gave those long-term margin targets. And then, as Joe pointed out, we have these challenges on the transportation side.
Well, in terms of our long-term target, we do revise it at year-end. So that's when we'll provide an update. It's going to be at our next disclosure of, the disclosure of our year-end results. That's when we're going to provide an update.
So should we be thinking there's logically more downside than upside risk given those items?
Well,
or is there an offset?
Say, on the transportation side, we're very comfortable with our guidance. On the aerospace, there was 4 or 5 elements that Guy had explained at the time that was to, basically bring us to our target of 10%. And, one of them was improve in pricing, increase volume, improve on demand. So those
items
have
that have
kind
been
of
slower
pushed to
than
the
we
right.
thought they'd be.
So.
Okay. Thank you.
Tim? Mike
Thanks.
after.
Pierre, you've got used $1.5 billion in cash from non-cash or from working capital in BT year to date. You've talked about $300 million from the derivatives, $300 million approximately related to those 3 contracts, leaving another $950 million, which again is unusually high. Can you provide just some clarity, some additional details into what other aspects or what else is happening in BT, and maybe talk about how much of that, I know the question was asked earlier about reversal of that next year, but how much of that could be reversed going forward?
Yeah, well, it's a question of the the various contract and where we're at which stage we are in each of the contract, and many contract we're in a ramping up mode, so we haven't yet started delivering, so therefore we're using cash because we're building up the inventory, and also varies in function of the various advances that we have, the profile of the advances for each of the contracts. So it's really the sum of the contracts are bringing that impact. For the non-edge one and the one where we have specific issues. So the other one is clearly the timing and the contract.
So
it does effectively reverse over time.
So if we just compared it historically in this business, again, correct me if I'm wrong, it's a very high number. It just has to do with an unusual mix of contracts, the number of contracts starting up, the book-to-bill ratio you've had, et cetera.
Right.
Okay. Thank you.
Give it to Mike, please.
Pierre, just a follow-up question on the pension liability. So you mentioned you're going from $1.6 billion to about $2.5 billion right now, but that shouldn't change your pension contributions, let's say around $350, $400 million.
The pension contribution is based on the funded one, which I've gone from 1 to 1.8, just to put in relation.
Just wondering, you mentioned part of the reason why there won't be any changes because the solvency tests are different than the accounting tests. Is there a risk that next year the solvency tests finally get adjusted? Is there just a delayed impact?
Well, first of all, it's the just to be more precise, the funding for funding purposes, and again, it varies country by countries. It's a calculation that is regulated by countries. And it is based on the actuarial valuation, and based on the like in Canada, it's long-term government bond that are of the same or similar duration, so 15 to 20 years in our case, and then you make the calculation, and then there's some measure that have been put in place where you amortize over a longer period of time. So is there a chance that the following year it change? The answer is yes, but it's an annual calculation.
All right. Okay.
And it can go the other way around, obviously.
Benoit? We'll take Benoit first, okay?
Yeah.
Okay. Pierre, just to come back on the investment grade, how important is the investment grade for you, not only from a cost standpoint, but also from a competitive standpoint, especially on the transportation side, given the trends toward PPPs? Do you feel that you become a little bit less competitive? And is there any things that you want to do in order to improve your second ratio?
Well, the investment grade in itself, that's a target, that's a goal. Is it an impediment to do business? The answer is no. We're signing new orders. We've been, non-investment grade for quite a while. We're the leader in transportation. We signed, record backlog. So, the facts are clearly indicating that it's not an issue. Being competitive on PPPs typically, the assessment of the grading and so on is on the financing vehicle itself. It's not on the provider of the supply. So it doesn't really impact. Is it important? For us, what is important is the strategy that Pierre referred to. One of them is, developing and investing in our product for the future, and that's what we're doing. We know that in doing so, we're using cash, therefore that's where we place the cash at this point in time, as opposed to use it to buy back some debt. So is it important? Yes, it is important, but in our priority, investment in our program have priority, and we believe that's the right thing to do.
Dave? Two Davids.
Okay. Pierre, just on the cumulative catch-up on the problem contracts, and that sounds like it had a negative margin impact in Q3. In Q4 or in some quarter soon, would we expect to hear from you saying, our margin was much higher in BT than the previous quarter because the cumulative catch-up was so large in Q3 that this had a noticeable margin impact?
The answer is probably not, in a sense that, when you have issue with a contract, it doesn't happen suddenly in a quarter. It's gradual. So we've been experiencing the Talent 2 in Germany. They were supposed to start getting delivered over a year ago. So we've been facing the issue. We've been incurring costs. We've been adjusting our margin accordingly. And you have contract, in all of our contract, we do estimate of our costs. We take into consideration some contingencies. And at the end of the day, some contract we do better in our estimate, some others we do worse. So in other cases, we have contract that we've done better that kind of offset. So it's kind of an overall portfolio, and it kind of balances it out. A little bit like various investment you do, it balances it out at some point in time. So that's what we see. So it's gradual. So it's not like we've took a 50 million hit, for example, in the third quarter. It is all reflected in the third quarter, and then I'm going to tell you in a quarter from now, well, the margin in the third quarter should have been 9%. I didn't bid for that amount. So you shouldn't expect large fluctuation.
Right. And just on the free cash flow, just splitting between the two divisions, like it sounds like you're going to do 500+ million positive free cash in the fourth quarter. Would you expect to see positive free cash out of both of the segments?
The answer is yes. We expect positive free cash flow in the fourth quarter for each of the groups.
Okay, thank you.
Okay, we'll take two last questions. Turan, to start off.
Yes, thank you. Pierre, I guess my first question, just a quick follow-up to what Benoit was asking earlier. In terms of transportation, obviously PPP is becoming more important and financing is changing in terms of the way transportation programs are worked. How important is the investment grade rating just from that perspective? Is that hampering your ability to get contracts?
The answer is no. If you refer specifically to PPPs, under PPPs you would have a structure that is put in place where you would have a specific structure that would finance the purchase of the train, infrastructure, whatnot. And this structure in itself is structured in such a way that it is typically investment grade. And the rating of the suppliers has no impact on the structure in itself. And you say we should expect to see more PPPs. I'm not sure that's going to be it is kind of the actual trend, but at the same time, it's very often more costly at the end of the day. than an authority that is being able to borrow and then buy the material.
Just maybe one quick one as well on the free cash flow side. How are your banks sort of viewing this timing adjustment? Because it seems like some of this could be pretty long-term timing in terms of the foreign exchange contracts as well as some of the BT contracts as they're in ramp-up stage right now. How are your banks sort of looking at this in terms of the discussions that you have with them?
I guess they're looking at it the same way as we do. We look at our liquidity. If I look at the liquidity at the end of the third quarter, having 3.5 billion of liquidity, that's enough or more than enough to be able to continue to invest in our program and cover the fluctuation in working capital. And we expect again in the fourth quarter to be free cash flow positive, so therefore increasing that liquidity level. So it's the overall liquidity profile that is important.
Okay, our last question is going to be from Walter.
Thank you very much. Walter Spraggan from RBC. When you look at your free cash flow projections and the guidance that you'll be giving us in January, if you're looking at about anywhere from 300 to 600 million in one-time or timing-related issues here, will you be adding that into your 2012 cash flow expectations when you give those to us in January?
Well, first of all, it's going to be next year. Guidance is going to be with the end of the year results. Adding it back like the 300 million on the hedging, I just don't know when it's going to come back because it depends on the exchange rate. Unless there's payment to suppliers, then I can calculate, at the latest when's going to be some of the amount that's going to be reversed. So, but in terms of the guidance, we will provide guidance with the year-end results.
What about on the 300 that is not related to the contract? In other words, the payments that should reverse itself.
It's going to be part of our overall guidance.
It will be part of that. Okay, thank you.
Okay, thank you. We'll now continue with André.
Sure.
Good morning, everyone. So I will cover three topics. The first one is to speak about our position as a leader of the industry, then about our innovative and cost-effective solution to meet all customer requirements, and finally speak to you about the market in order to show to you that thanks to our solution and to a robust market, we have what it takes in order to secure future orders, meaning growth. So first of all, in terms of leadership, after a record year of order intake last year, you can see that even if it was not at the same level, we have secured significant orders this year and orders we have potential for the future. And I would like to mention, for example, the order for Deutsche Bahn for the ICX train, because the 1.8 billion that we have secured this year is only the first tranche. There are options of up to 3 to 4 billion coming in the next years to come. Also, the signaling in London, which is the largest ever signaling control for CBTC, I will have a slide about it, or close to $550 million. It is the first time that we enter in signaling in London, which is one of the biggest systems in the world with New York and Paris. Like the system we won in Gold Coast in Australia, and the Gold Coast has now won the Commonwealth Game, meaning that this system will be expanded going forward. Like the Chicago cars, additional options. It shows that once you have secured a relationship with a customer, you get additional orders coming forward. And last but not least, we continue our successes in Brazil because after the monorail in São Paulo, modernization with CPTM, we have won now a CBTC line of signaling. There again, a significant contract of $100 million, which confirms our leadership in CBTC signaling. So these orders leads to a strong order backlog at $33 billion. And we are confident that we are on the right track to reach our 8% margin with the levers that you know well. However, as it has been discussed this morning already, this year we are facing a challenging year in terms of free cash flow. We have already discussed this morning the 3 contracts, so I will focus on the action. Good news is that now we have delivering or resumed deliverings, because for Ile-de-France it was only suspended for these contracts, meaning that the problems are going to be solved in terms of free cash flow over the next quarters. But also we have learned the lesson, especially in the Talent 2. We are not the only one to face a new homologation situation in Germany, which has dramatically changed. So our competitors are suffering too. It's not an excuse, but we have learned the lesson, and now we have completely changed our way of approaching homologation in Germany in order to make sure that we don't face the same issue going forward. Pierre has also mentioned this morning before the fact that anyway this year was not going to be a good year in terms of free cash flow, because if you remember, we took a large order intake last year, meaning that we have a lot of projects going up in terms of inventories right now. So we have, by structure, negative free cash flow this year, but it will be recovered over the time. And last but not least, it has been explained a lot about the hedging issue. Coming back to our leadership, we have one very specific advantage compared with our competitors, is that we are by far the most diversified, not only in terms of segments. We are the leader in 9 segments out of 11, but also in terms of countries, because we have presence in 25 countries, either production or engineering, which is by far the most diversified presence among competition. So now, if we look at the solutions that we have, even if the fundamentals of rail are extremely strong, they require different solutions than in the past. And I would like to address 3 parts to show what kind of different needs and requirements the markets are looking for today. The first one, part A, is about the innovative and cost-optimized solution. The second part will be about what we do in order to enable more integrated network. And the third part will be about how we build local capabilities and long-term partnership with our customers. If we start first by the part about cost-optimized solution and innovative solution, the first issue that our customer has to solve is the infrastructure issue. Why? Because it is aging and costing a lot in the mature market, and in the emerging market because they have to build new infrastructure. The other challenge that they have to face is that due to the increased urbanization and the mobility demand, they have to face a huge capacity issue with a constraint, which is infrastructure. But at the same time, like anybody else, they have budget constraint. So meaning that they are looking for extremely innovative and cost-optimized solution. And I would like to give you some example of what we do as Bombardier to be ahead in satisfying these challenges. I will give 3 examples about the infrastructure: the double-deck trains in Switzerland, our new generation of Trax AC3 locomotives, and our CityFlow CBTC system, especially in London. I will speak about how we reduce energy and cycle cost to our customers with the example of the double-deck regional trains in France. And finally, speak about the increase in capacity and reducing cost to install new system, speaking about the monorail in St. Paul and about the Montreal Metro. First, infrastructure. The success of this train is, at the beginning, a success for the infrastructure. Because as we were the only one to be able to tilt a double-deck train, and we have been able to increase the speeding curve for a double-deck train by 15%, this has allowed the Swiss railways to avoid 900 million on infrastructure upgrade to keep their timetable. At the same time, we have provided them with an option, which is an active radial steering, meaning that on the bogies you have a slight turn of the wheels, which, if they exercise this option, will give them an additional benefit of $280 million per year in infrastructure maintenance. At the same time, because they can use a double deck, they can increase the capacity on the same line by 60%. So this is how, with a train, you can solve the infrastructure issue of a customer. Same with our new generation of locomotives. We are already the leader in electrical locomotive, but when we come to design our new electrical locomotive, which is the Trax AC3, we came with a new idea, which is to install in the electrical locomotive a small diesel engine. Why a small diesel engine? Because right now, when an electric train wants to go up to finish its mission, as the line is not electrified up to the premises of the end customer, then you have to stop, you have to put a shunting locomotive and take the train up to the end mission. Now, with this locomotive, you can switch the small diesel engine, and then you can finish the mission. And obviously, it's very interesting for our customers, the freight operators, because they can offer hand-to-hand services to their end customers. And this locomotive is homologated in all European countries. Third example, the CBTC contract that we have won in London. It will equip 40% of the SSR network, meaning that all in all, this system will equip 25% of the London Underground. We have been selected specially because we are able to install this system only during the shutting hours at night. And we are the only one to have done that already in Madrid. So there again, a competitive advantage. But why London is doing that? London is doing that because thanks to this new system, they will be able to increase the capacity per hour from 24 trains to 32 trains, meaning that they have computed, and this is their figures, that they can save, in terms of increased revenue and reduced cost, $600 million per year. Investment 550, yearly saving 600 million. You can see the benefit for London Underground, and meaning that now we are in an extremely good position with this customer. There again, solving an infrastructure issue for our customers. Now, if we go to reducing energy, this is a new regional train, double deck, that we have won last year for France. If you compare this train with the previous generation, which is not only 5-6 years old, we have been able to reduce the energy consumption by roughly 50%. How? First of all, we have used a new technology, which is called permanent magnet motor, reducing the energy by 5%. We have put a new generation of auxiliary and traction inverter. There again, reducing 15% more energy. And last but not least, we have put driver assistance system, which can allow again another 15%. And there again, you can see the benefit for the operator in terms of cycle cost. Third part, how to increase capacity. This is a monorail in St. Paul. This line will cost 18% less than a conventional metro line. So meaning that for the same capacity, you can have a system which is cheaper to install, faster also to install than a metro, because this system will be on time for the FIFA World Cup, which was in 2014, and the metro will have taken longer. And at the same time, it can be built without any major disruption in the city of St. Paul. And right now, in Brazil, we see a lot of opportunities to sell monorail systems. There are projects in Recife, additional projects in St. Paul. And we are looking now to other countries like India, China, because we think there is a market for monorail. But there again, there are not a lot of competitors which are able to offer such monorail, especially at this high capacity. But even on conventional metro, and even when you have a lot of constraints, like in Montreal Metro, because you cannot change the width of the car, you cannot change the length of the train, with a new arrangement of the interiors, and there will be no gangway in the Montreal Metro new generation, and with ergonomic seating and comfortable interiors, we are able to have 24% more capacity on the same train than on the old trains of Montreal Metro. There again, we solve a capacity issue for our customers. So now, if we move to the second part, which is how we support more integrated networks, I would like to give you some example of how we help to enable cross-border operation. And I will give the example of our multi-system locomotive in Europe and of our very high-speed train Zefiro. I will speak about how we help to develop compatible technologies and with the Interflow ERTMS system, for example, in China. How we help our customers to design more adaptable products for the end customer, meaning the passenger, with the Talent 2 in Germany and the Flexity 2 tram. And also, I will speak about intermodal operation with our new PrimeMove solution. So if we start with multimodal, multi-system locomotives, the TRAX multi-system, in Europe, there is a directive now from the European Union about trans-European network. But in order to operate on trans-European network, you need to be able to operate in different voltage and system because they are not the same in Europe. You need to be able to read all the signaling system, including the ARTMS system, and this is what this locomotive does, meaning these locomotives can go on every corridor. It is homologated, meaning that there again, our customer, freight operators, can have a point-to-point service within Europe without having to stop at every border to change locomotive. And there again, we are a clear leader in this operation. In very high-speed train, you have here a picture of the new very high-speed train for Italy. There again, it will be the first very high-speed train able to be operated in Italy, Switzerland, France, and Germany. So truly cross-border, giving a competitive advantage to our customer, Trenitalia, at a time where there is a liberalization of the very high-speed network in Europe. But it is also a train which is highly scalable in terms of different possibility of traction, very high acceleration, and it can be done also in different different widths. For example, in China, our Zefiro trains is wider than in Europe. So another example of the flexibility of our design. ERTMS, we are the leader in supplying ERTMS in China, by far. We have supplied right now 3,650 kilometers of line in China, both in high-speed line and dedicated lines. And what is important here is that we have won this contract because we have worked with a Chinese partner and demonstrate to them that we could be compatible with the existing C2, so-called C2 system. So there we have demonstrated our capability of interoperability between new technology, ERTMS, and their existing technology, meaning that they can build their system gradually. This is what it is about. Flexity tram, Flexity 2, we have launched this tram worldwide in Blackpool in the UK, and now we have won Gold Coast. We have been awarded, not yet signed, Basel in Switzerland, and we have a lot of contracts, a lot of potential orders going forward. This tram is extremely successful. Why? Because there again, we are offering to our customers a lot of standardized options, meaning that they can customize the front end. We have an open tube interiors, meaning that they can really fit the interiors the way they want in order to give the right image to their city. But at the same time, we have thought a lot about the daily operation of this tram in terms of accessibility for maintenance, in terms of how do you repair if there is an accident. And this is also one of the winning points that we have in this product. Talent 2. We start to deliver, and it is a very big success with the customer. So meaning that I'm convinced that after the problems that we have had, this train will be a big success. One of the difficulties we have had in order to deliver it is that, in fact, Talent 2 is up to 250 different trains, different configurations. So it is highly flexible and scalable, meaning that we can offer different interiors, and the welcome by passenger in Nuremberg and the media coverage has been extremely good in terms of comfort, in terms of new features that this train can offer. But also for our customer Deutsche Bahn, it means that they can convert in the future, if they want, a regional train to a commuter train. They can modify and readapt the train. So it is a new solution. And it can be also done in several voltage and tension, so meaning that this kind of products is a game changer in terms of regional train going forward. And last but not least, PrimeMove. PrimeMove is our induction technology, that we have designed in order to allow catenary-free operation. We are the only one to be able to transfer a high level of energy through the system, so it's patented. So it's already in operation in a line in Augsburg for tram. We have a pilot line for bus in Lommel in Belgium. We have also a car equipped, Volvo in Belgium. And we have a Vito van in Mannheim. And we have a lot of traction right now with the buses operators. And I'm convinced that next year we will sign the first commercial contracts for buses, which shows that we can use our technology even for other customers than the train operators. Finally, the part C, how we can be partners to our customers. In emerging markets, obviously, they are looking for localization, and I will come to that, but also for partnership with them. But even on mature market, with the liberalization of the market, they are asking us more than just supplying rolling stock. So in localization, I will speak about India and Brazil. In PPP, which was mentioned, I will speak about Gautrain in South Africa. But in terms of new services to our customer, modernization in St. Paul, how we do our services activity in the UK, and last, but I will speak about how we also do operation and maintenance and not only services. So first of all, India, we are by far the most developed manufacturer in India compared with other competitors. We have a complete organization in India. From engineering, we are in Hyderabad, but also in Vadodara in engineering. From a local supply base, we have a factory for propulsion in Vadodara. We have a factory for bogies. We have a factory for complete passenger cars, where we have delivered more than 500 cars to the Delhi Metro. So we have uniquely positioned to benefit from the growth of the Indian market going forward. And this is, I will come back to the market later, one of our strategy in a country with a strong potential like India is to become an Indian player. And so we are doing the same now in Brazil. Immediately after winning the São Paulo Metro, we have decided to localize in Brazil the manufacturing of the monorail cars. We had a plant in Hortolândia, so we have decided to expand this factory, and 70% of the contract will be made in Brazil, which, by the way, protect us against taxes or movement in terms of regulation in Brazil, because we will become a Brazilian manufacturer in Brazil. And guess what? Based on that, we are increased success in Brazil. I mentioned the Line 5 with CPTM, additional monorail, because we can explain to the potential customers in Brazil, to the cities like Recife or other cities, that yes, we are a Brazilian player and we are not shipping the cars from somewhere else. Gautrain, a PPP, extremely successful, delivered on time for the FIFA World Cup in 2010. It has been a huge success in South Africa because all in all, not only for trains, but this system has created 60,000, more than 60,000 direct and indirect employment in a country which need employment. And if you take Bombardier, 90% of our employees are South African, were, because now it's decreasing, and are South African. But we have invested a lot also in the community, invest a lot on training. For example, here you have a picture of a woman graduate of our leadership training in 2010. Because there again, we think that there is potential in South Africa, and we want to invest and be a good community corporate citizen in South Africa. Now, if we move to the new services that we can offer to customers, not just being a supplier of rolling stock, first of all is modernization. And you look at Brazil, another example for the CPTM, so the Metro of São Paulo. You look at the car before and after, different exterior look, completely different interiors, so more appeal to the customer. Look at the driver decks too. So it will be a 25% reduction in terms of cost of maintenance, higher reliability for passenger, and we completely change all the propulsion system to put new modern propulsion systems. So we give a new life to this rolling stock. If we look at UK in terms of services, we give services to 23 transit operators in the UK. We maintain daily over 40% of the UK fleet. And for some of them, like Virgin, for example, they only do operations, so meaning that we give to them the train in the morning, and they operate the train. They are the only things they do. And we think for us it's the best model that we want to see forward. But the model can vary from one customer to the other, so it can be complete fleet maintenance. It can be also, from time to time, we do asset modernization, the same that I mentioned to Brazil, so we give a second life to a rolling stock. It can be material solution. For some of them, we give them a yearly contract for material solution where we take responsibility of the consumption of the material and we supervise their staff, but they do the maintenance themselves. It can be component overall. So this is a very mature market in terms of liberalization, but we are convinced that this will come, especially with the budget constraint in other countries. We see now it's already some customers in Germany. We see that in Italy, the customer is very interested in Spain because obviously this is a way for them to reduce cost if we are able to take over this maintenance. Operation and maintenance. So obviously we do services, but sometimes we even operate. We operate the Go Transit fleet, but we operate also a lot of airports. All in all, we have 23 sites where we do both operation and maintenance. You are going, for those of you who go there, to visit one of them, which is JFK AirTrain, where we do the operation and services daily of the AirTrain in JFK. But we have the Madrid airport, we have the Atlanta airport, Beijing airport. So we have just one Munich airport. We have also Frankfurt airport. So we have the biggest airport in the world. Are both operated and maintained by Bombardier. So now, if you have excellent solution, you need also a market. So that will be the third part, is to see and to explain why we are convinced that the market is extremely robust. So this is a result of the UNIFE survey that was done last year, and the new survey will be done and published for InnoTrans in September. And we are convinced that the new survey will show at least the same level or roughly the same level of growth. The market is extremely robust, and we still forecast a growth which is 2% or 2.3% going forward. Europe will remain the large market with 53 billion per year. And in this market, we are uniquely positioned thanks to the different options that we have, and I will give some example in the different contracts. There is potential for rolling stock, renewal of the fleets are aging. There is all the movements to renew the signaling, so there is a very robust market in Europe. Asia-Pac, very dynamic market, driven mostly by China and India, but not only. Now we see opportunities we were not there in the past for new mass transit system in Malaysia, in Vietnam. There is a very strong, robust market in Australia. So this is a region which is extremely growing going forward. NAFTA, solid and robust. Mass transit system, next year an award for BART in San Francisco. There is tenders for New York. Movement also in signaling, but I will come back to the market later. And the other, Brazil, is also a very significant market. So now, if we look at this market, I would like to explain why we are well positioned on this market. If we take Germany first, Germany roughly represents 20% of our market in terms of revenue. And if we look forward, this market is extremely strong in the years to come. There are several light rail systems which are planned in Düsseldorf, in Bremen, in Frankfurt. There are regional and commuter train. There is a tender which is out for Rhein-Neckar, for Rheinmain. There are two major S-Bahn systems which are going to be tendered next year, one for Berlin, one for Hamburg. In Intercity, even if the tender has been won together by Siemens and us, there are options to come. And in locomotives, there will probably be a tender for Deutsche Bahn for both regional traffic and for freight traffic of a new electric locomotive. So as you can see, all across the product line, very strong market in Germany. If we take France, to show the importance of transportation in France, yesterday, for a new rolling stock on a line in Paris, the head of state went to the inauguration. Okay, so that shows how committed they are in France, whatever the party, to transportation in Paris area, because it is one of the key concerns of the Paris area. So we have a lot of market going forward. There is a new rolling stock tender for the RER-E, which will be a new tender. But in addition, there are options. MIO9, we are in partnership with Alstom, so we should go our way. There is new option for Île-de-France. If you remember, we have won a firm tranche of 172 trains. There are 200 trains in the option, have to come Bombardier way, one way or the other. And regional train. The Omneo trains that I showed to you, there is a frame contract is for 860 trains. We have only booked in our backlog 129. So this will come also in the years to come. But it's not only Germany and France. In the UK, we are right now discussing or tendering medium-sized project. There is Crossrail, which will be tendered next year. If we go to Switzerland, the double decks that I showed to you, there are additional options going forward, which are for Bombardier, but there is a new tender which will come next year for single-deck tilting train. So there again, a big customer in Swiss Railways. Denmark, a new signaling system for the complete Denmark. Stockholm Metro, Brussels driverless metro. So as you can see, an extremely robust market and pipeline of orders in Europe. China and India. China is already the biggest market in mass transit worldwide, but is also developing fast their high-speed system. So going forward, we are convinced that China will continue to invest in their high-speed system, and they are confirmed, even if they have decreased a little the previous forecast, it is still higher for the next 5 years than what they have invested, which is huge for the last 5 years. So it's still a major market. But we see new opportunities in mass transit where we are not a big player in metro, but new products are coming right now in China for which our Chinese competitors don't have the technology, meaning that we can play. One is light rail, LRV. The other one is commuters. So there is a new opportunity now in China. India, there are major tenders for locomotives. In electrical locomotive, for example, India has put a bid, but now we are waiting for the bid date for 800 locomotives, including maintenance, including building a plant in India. And there are additional systems in mass transit. We are right now bidding in several cities, and there will be an additional tender for Delhi Metro of more than 400 cars next year. So as you can see, once again, a very strong and active market in India. And both in China and in India, we are uniquely positioned thanks to our local presence. In China, our 2 joint ventures. In India, our 100% owned factories and plant. North America, opportunities in signaling and positive train control. Mass transit, I mentioned BART, but there are other tenders to come. Like, for example, here in New York, there will be a tender for Long Island for single cars. The previous generation was supplied by Bombardier. And even in high-speed rail, even if I don't see really a new high-speed rail coming soon and fast, very high speed, there is high-speed opportunity, bi-level coaches, the same that we have sold to New Jersey, that can be increased in terms of speed. And there is a tender from Amtrak for additional Acela coaches. There again, where we are going to tender. So there we see also a robust market in North America. So as a conclusion, we have the right solution in terms of cost, in terms of innovation. The market is here going forward, very strong. Now we have to make sure that we satisfy our customers. And I want to reassure you, even if we have some glitches, as we have on these 3 contracts, most of our customers are satisfied. Don't forget that we deliver every year roughly 200 contracts in parallel. And even if we have some issues from time to time, our first goal in that case is to regain quickly the trust and the confidence of our customers, and we are good at it. Thank you very much.
Thank you, André. We will now start our question period. I think we'll have to start with David. Hold on, okay?
Andre, just sort of getting back to the advances question once again. If you look in Europe and Eurozone debt crisis, et cetera, are you doing anything at all? I know you don't provide financing, but is there anything that you do in terms of your sales campaigns, forward-looking, that you provide a bit of a concession to your customers, maybe a little less down now, kind of leg into the program, then have milestone payments a little bit higher as you have completion?
Now, as Pierre answers this morning, the situation is highly different, very different from customers to customers. You have customers that, and still a lot, which are cash rich, and being cash rich, they will discuss with you, what about the price if I give you higher level of advances? And some of them are strongly over-financing us. Okay. Other customers, which are more cash constrained, we will have to negotiate more on I will say, a more difficult basis, the milestone payment, in order to ensure as much as possible to remain cash positive. Okay? So that's very variable customers to customers. Having said that, if we look years over years in terms of the level of advances that we receive on our order intake, there is not a dramatic change. Okay? It can vary from 1 year to the other year, but it does not change dramatically.
Okay, the second one, if I can just sort of squeeze one in here. In China, are you seeing China Southern and those guys sort of less on the competitive market given their mishaps at home?
Well, first of all, they don't have, we have to be careful because the issues that happen in China have nothing to do with Chinese manufacturer per se. Okay? We still are waiting for the reports, but
just perception.
It's perception, but in terms of reports, it seems that most of at least for the high-speed accident which happened during the summer, it was a human error, which most of the time happen in operation, if I may say so, when there is an accident. So I think that it obviously leads to a change in the customer attitude, not the competitors, the customer attitude, which becomes even more, because they were already very demanding, but even more demanding in terms of safety, and I think it's good. So we will have, all of us, our Chinese competitors and Bombardier, because we are one of the Chinese competitors, to adapt to these new rules. Having said that, I don't think, even if there is a perception, I don't think that on the medium long term it changes the behavior nor the perception of our Chinese competitors, and we don't count on that in order to be competitive against them on the external market. We believe more in our innovation than in the perception on Chinese product.
We have one from Walter here, Snape, or Patricia.
Just understanding that you're very optimistic with regards to the sustainability of your demand profile, despite all the problems that are happening in Europe. If we were to step back and just, through looking at a scenario analysis here and just assuming that we do see a reduction in demand and lower volumes, can you walk us through what your view of your incremental margins are? In other words, how much volume reduction can you see or sustain before you start to see your margins start to come off? And how much of your 8% is built around the expectation for at least 1 times book-to-bill or higher?
Alors, first of all, there is our best protection on whatever volatility of the market is our backlog. Okay? We have 33 billion of backlog, which is roughly 3.5, 3.3 a year of sales. So meaning that whatever impact we might have on a lower book-to-bill will take a long time in order to materialize in our revenue, thus in our margin level in terms of absorption on fixed cost. What does that mean? It means that I confirm that our guidance for 8% in 2013 will not be affected because most of what we are going to sell in 2013 is already in our backlog. It also gives us a strong advantage is that we can see it coming even, and I don't believe in it, but even if your doomsday scenario was to come, it gives us time to adapt our fixed cost. And the good news is that we are a low fixed cost industry. Our factories are low, not big capital investment. We can reduce white collars, even if it's a little painful in Europe, so it will cost some money, but meaning that the cost of adaptation is not huge. Okay? So meaning that once I'm convinced that the market is here, but even if I was proven wrong, I'm convinced we can adapt. So the impact will not be extremely volatile in terms of profit. What we can miss is gross opportunity more than EBIT impact margin.
Well, that certainly makes sense. I appreciate that. Is there any how that very important and very strong backlog, as you mentioned, how sustainable is that in terms of locking your customers into honoring the contractual commitments that they've made? In other words, is there significant penalties, or is there anything that you can provide to give us comfort that that 33 billion backlog is a strong?
If you look at the last 5-10 years, in terms of cancellation of a customer from a given contract because he had no money or no more business case and things like that, I can remember one significant that we negotiate for the best.
Okay? That's very helpful.
And when I say significant, it was in the low three-digit range.
Thank you.
Okay, so that's the reason. Normally, this is a good news by dealing also mostly with public customers. Is that when they place an order, they normally 95% of the case they have secured the financing. For example, let's be even more precise. We have 2 key contracts in Italy right now. One is a very high speed. The other one is our locomotives for Trenitalia. Even if Italy is facing some budget constraint right now, I'm not worried because Trenitalia needs this very high speed train in order to compete against SNCF, Deutsche Bahn, going forward, and they need this locomotive. So I'm confident that we will deliver these 2 contracts.
Take a question from Chris.
Thank you. You talked a little bit about the fact that homologation had changed in Germany. Can you give us an idea of what exactly they've changed? You talked a little bit about lessons learned, and can you talk about if there's any spillover to either other EU countries or other contracts that may impact in the future?
What happens in Germany is that in fact, in Germany, EBA, which is homologation authorities, following an accident which happened in Germany, some of the officials from EBA went to court, meaning meaning that their responsibility was they were put to court because of the responsibility. Obviously, that gives to the official of these homologation authorities a different view of the world because it means that they have to take more safety concerns that they had before. For that reason, they have become much more precise in every documentation that they require. They have also required much more testing than was required before. They have required a lot of changes in terms of the way they appraise a safety of different systems. What does it mean for us? It means that when you have to do that at the same time that you are designing one of the most complex contracts that we have ever had, which is a Talent 2, it means that we have to redo several software, several systems while developing the contract, creating a major disturbance. But having said that, lesson learned is that we have to cope with this new way of working, which is a way of working with the safety authority, and the safety authority is a rule in a country. So we don't have to complain, we have to work with that. So what we are going to do now is to make sure that right from the beginning, contrary to what we were doing before, we are going to address this issue by discussing with them on a continuous basis, making sure that every step of what we do, we get an approval of the way we do things. We are not going to be protect 100% by doing that, but at least we are going to decrease the disturbance while developing the project, and hope with a good cooperation on both sides, we expect with that to come to the delivery of the train with a complete agreement, instead of what we have done up to now for the Talent 2, where we have manufactured the train, at the same time went for homologation, and then discover that they were not satisfied. For the time being, we don't see the same move in the other countries of Europe, but good news is, if it happens, we will be prepared, because we will have done the right work for Germany, so we can now do the same for other countries if and when needed. Does that answer your question?
I'll take a question from Hamza, and I'll take a question from the webcast before Hamza, okay? Please pardon the pronunciation. The question comes from Germany, from Michael Terrell, from Raffenson Landsbank, or something similar to that, sorry. Do you have an update concerning the status about the mega project Talent 2 with Deutsche Bahn in Germany, André? A few days ago, Deutsche Bahn announced that they gave a framework contract to Stadler, Alstom, and CAF, the biggest contract up to 2 billion in the history of Deutsche Bahn. Bombardier did not receive an order in this tender. What is the strategy for Bombardier in this case?
Alors, first part of the question about the delivery of the Talent, as we said, we have started delivery on the Talent. We are going now, together with Deutsche Bahn, to start the first franchise operation in Nuremberg for December 11 or 16. So meaning that we are starting now to deliver franchise after franchise. It is a long process. I come back to the question that you had about when and how the inventory or the trains will be delivered, but you have to remember that we are delivering this train for several franchises. So we have, for all these franchises, we have to get a specific homologation approval. We have to get a delivery plan with Deutsche Bahn. We have to train the drivers. So it takes time. So it will take over the next quarters to deliver all that. Now, about the new frame contract, first of all, it's about competition. We cannot win them all with Deutsche Bahn. At the same time, we know what it takes to make a regional train with in these new conditions. So we have a new good products now with the Talent 2. And we see also that there are other opportunities in Germany that I mentioned, like Rhein-Neckar, Rhein-Main, S-Bahn in Hamburg, in Berlin. So sometimes you have to choose your battle. And on this one, it's a frame contract, which is a little new style, meaning that it is not really a frame contract. It means that these three competitors will be allowed to bid on each and every franchise, meaning that you get a very competitive process at the end, if you see what I mean.
Hamza?
It's a two-part question. The first part is, if you could maybe talk in a little more detail on the Chinese manufacturers, where are we in the technology transfer process? Do you eventually envision some of these Chinese manufacturers bidding against you on billion-dollar contracts? That's not happening right now, but does that happen long term? And then second question is, given your free cash flow situation right now, given the macro uncertainty, is it fair to say you're not bidding on the Finmeccanica asset?
Alors, first of all, on the first part of the question, which is a Chinese car manufacturer, they have good products in high speed and very high speed, and they are delivering good products in high speed and very high speed. And so we respect their competition on that segment. For the time being, one, they are very busy with the Chinese market in high speed and very high speed. Two, there are not that many projects outside of China in high speed and very high speed which are not in Europe. And they are not yet ready to bid this kind of project in Europe. So for the time being, we don't see them in this range. If we move to other product range, for the time being, they don't have the right technology. The key and strongest market, bigger market in Europe is regional commuter. They don't have regional and commuter train. It's LRV. They don't have LRV. They don't have intercity. They don't have double deck. They don't have tilting technology. Okay? So meaning that in addition of the difficult task to come in Europe, customer intimacy, homologation, EBA, other issues, they have to build a totally new set of technology that they don't have in their portfolio right now. So meaning that if we look at the last year, outside of China, we have not lost any tender against a competitor from China. Having said that, going forward, we will have to take this new competition and respect this new competition. That's the reason why I try to demonstrate to you that the way for us to keep our leadership is to stay ahead in terms of innovation, cost-optimized solution, new technology in signaling, new technology in permanent magnet motors, everything that can make us ahead of the competition. And don't forget, last but not least, that if and when they come to Europe or to the US, they will have to manufacture locally. So meaning that their cost advantage will disappear. They use a Chinese supplier. We use Chinese supplier too. We are a Chinese competitor, so we know how to build and to compete the Chinese way. So we are not afraid of this competition, but we will respect it. On your second point, we don't comment on any move. So if you want to ask question to Finmeccanica, please feel free to ask question to Finmeccanica.
Thank you, Hamza. We'll take a question from Marco.
If I look back at the history of BT 8, 10, 12 years ago, it used to be that you had problems with a number of your high-profile contracts. And in the last 5, 6 years, you've actually had very good execution, which has shown up in the expansion of your margins. So my question is, sort of what's changed where now we appear to have a number of programs coming off the rails, if you'll pardon the pun. And I'm just curious, is you can look at sort of where it went wrong. I mean, you've identified the homologation issue, but is it your bid process that's incorrect? Is it execution? Is it complexity of the products? Or is it that BT is as big as it is today with the number of programs that you have that really managing all of that has become much more problematic? And why should we have confidence prospectively that you're not going to run into similar snags?
Marco, first of all, it's not true that during the last year we never had problems. We are in a project business. In a project business, you have projects that goes well, projects that go extremely well, and projects that goes wrong. Okay? And the name of the game is to make sure that all in all, as an average, you can deliver better than what you have bid for. And this is what we have done by increasing the EBIT from roughly break-evens 8, 9 years ago to being at 7.2 right now. So this is an average all the time in terms of different projects. So you see 3 projects that are going wrong, but at the same time, you see the margin still at 7.2, so you can imagine that some of the projects are going extremely well too. So that's to put things in perspective. We focus on these 3 projects this year, not really because of the EBIT issue, but because of 2 issues. First of all, cash. Second thing, because we recognize that we have to rebuild some customer satisfaction on these 3 projects, and this is one of our key targets. So that's, I think, having said that, it's true that I mentioned homologation in Germany, but this is one point. There is an increased complexity in our trains, and this is our business to master this increased complexity. So we don't take this issue lightly, meaning that I mentioned what we do in terms of lesson learned for homologation. We also do a lot of lesson learned in terms of the fact that we have more and more electronic, software, complex train, And so right now, for example, we are recruiting more and more specialists in order to be sure that the issues that we have faced on this specific contract will not come back on the project to come. So I'm confident that we will continue to deliver good profit going forward.
And a related question is, given that you've been delayed as much as you have been on these particular programs, the programs that were to follow once these were completed, presumably they've been pushed out. So my question is how have you dealt with those programs, and should we anticipate any costs or penalties because you're delayed on those?
No, because we, as Pierre Allary was mentioned this morning, we have not discovered this problem on a given day, on a morning. Okay, the fact that we have this increasingly issue with the talent tool as a problem that has come quarters over quarters. Okay, meaning that we have been able to replan a lot of things, like for example, increase our engineering capabilities in order to cope at the same time with the increased effort on the talent tool and treating the new project that we have to treat. And there again, don't forget, this is for the engineering part. For the manufacturing part, there again, we have a very flexible industry. We have a lot of capacity. So for us, it's just to make sure that we hire the necessary people. Short term, we have very strong induction program to make sure that they have the right processes and that they work well. And this is the way we have worked, for example, in electrical locomotive for years. Okay, we have ups and downs in the manufacturing, and we have ups and downs in the manufacturing workforce. So this is not an issue for us.
Thank you.
Benoit? Thank you, Benoit.
Okay. André, looking at 2012, could you summarize the big contracts that you'll start delivering, and what is the level of complexity for those big contracts?
In terms of delivery next year, if I summarize roughly big country by big country, we are in Germany. We are delivering the talent tool mostly, okay, meaning. And we are building, also starting with, but mostly in engineering, not in delivery, the double decks that we have won, which is an option. Not an option, which is a new contract, but this is one of the contracts I mentioned where we have a lot of call-off and option. And we are starting the engineering of CICX. Okay, so that's roughly what we do, apart from locomotive, light rail, etc. In France, it's only Île-de-France, MIO9, so there again, the contracts that we have already engineered, and we are in the phase of engineering of the double deck. In the UK, it's an ongoing delivery of the subsurface cars, so they are already accepted, engineered, delivered, so this is no risk. In North America, Montreal Metro is going quite well. We are delivering CTA, which are again engineer, accept, ongoing. So you see that the level of risk next year does not look high, but we have to be careful and to make sure that we don't that we keep our focus on execution. And in China, we are building, growing the engineering for the first cars for the Zefiro VI-speed train. But the first delivery will be only at the end of the year.
David?
Hi, two-part question. So the global market growth that you talked about, Andre, the 2.3%, that seems like a number I've seen forever, more or less. No? You're going to say no, okay. Because it seems to me that it's not changed a lot, at least in a number of years from the reports I've seen. So I'm just wondering, is it really changing? It seems hard to believe it wouldn't be changing some to the lower because of the global economic situation. And then related to that, for 2012, with all the projects you listed, do you think you're in a position where you could actually get a book-to-bill at 1-to-1 or greater?
On the first part of the question, I would like to remind you that we have grown, except for last year, 7% per year. So even if we have outperformed the market was not zero. Okay, so meaning that it has been robust. Okay, so when we say 2.3%, it's lower than what we have experienced in the past. Okay, so that's the reason why I am quite confident that we will see. Now, in terms of book to bill, look, even if I hear some of you telling Europe is not going well and things like that. We are at 0.9 this year after 3 quarters, coming from 1.6 last year. So meaning in an average, we are at 1.3 book to bill on an increase of revenue. So meaning that it's a big order intake. You saw the pipeline. So it's very difficult for me to give you a guidance. I will do that at the end of the year. But normally, so one does not look as a stupid figure.
So just sort of following up on that then, would you say that what you just described to us in terms of all those potential opportunities would be as big as you would have described to us a year ago or 2 years ago or 3 years ago?
Alors, to be very precise on that, since August, which is, let's say, the start of the European crisis, I think I've seen only 1 or 2 projects that has been cancelled or delayed. Maybe a little more, 3 or 4, and not major ones. So I think that's really the answer to your question. The question is that do customers still have the same plans? Yes. But there again, you have to maybe remember that if you look at Bombardier, we are the leader, number 1 in Europe by far, but we are the number 1 where? In Germany, 20% of our market, 20% of our revenues, in France, in UK, in Nordic countries, in Switzerland. So these are not economies that don't go well. We have not a big market share of rolling stock in Italy. We have close to 0 market share of rolling stock in Spain. We have never sold any rolling stock in Portugal and Greece for the last 8 or 9 years. So we are not really affected by the current crisis as a manufacturer. Spanish manufacturers are, but we aren't.
Tim, you had a question? You no longer have a question? No problem.
Well, it was sort of addressed. I was actually just going to, it seems like what's going on in Europe really is not affecting your business, period, whether it's the outlook, advances, customer financing requirements. I was just going to ask if there is any aspect of your business at all that is being affected by this.
Financing is a good point because I would like to rebound off one question that Pierre got this morning about the PPP. If we look at the pipeline that I mentioned, there are not that many PPPs going forward. Even if you follow and I don't know what will be the end result, but even if you follow what happens right now in Crossrail, which was supposed to be at the beginning exactly the same copy-paste of the PPP Thameslink, which is not our cup of tea, to be honest. It seems that right now there is a debate in the government about whether she should go for a PFI or whether she should go for a different way of bidding, meaning rolling stock on one side and then financing on another side. So there are not that many projects, except in some emerging countries where we see a requirement for PPP, and especially in Western Europe, we don't see a lot of them. In China, none. In India, yes. So it depends a lot of the geography.
Mike?
Mike Womsey, CIBC. Just moving to China, things slowed down in the summer after the rail accident. Any update on when bidding activity or tender activity could start again? Are we still 6 months away, 12 months away?
I think that probably in the next year we will see some activity again. Once again, for us, it's not an issue because we have a big order, a big backlog with our Zefiro train order. Okay, so meaning that we are not in a hurry to get new orders. It's very difficult to forecast in China, so I prefer to be very cautious. But the signals are that now that after digesting the current transition, which was not only the safety accident, but also a realignment of the development plan toward less very high speed and more conventional high speed, 250, 200 kilometer hours. So that requires some replanning. Okay, I expect that a new activity next year to come.
And just another question on Asia Pacific revenue was down a decent amount recent quarter, it was mentioned there was just some programs
Yes.
ramping down. When are the next programs ramping up? Is it this quarter, early next year?
Which was clearly the fact that we were finishing some trains which were 250 trains for China. So meaning that we will see with the Zefiro contracts picking up, we will see more activity in Asia on the years to come. And there is also Delhi coming down also.
Is that a quarter or two, or like?
Honestly, I don't know the answer because to look at a given revenue on a region, it can be volatile on a quarter to quarter according to the mix of contracts. So I don't have the answer top of my head, but Shirley will give you.
Okay, thank you.
Thank you. We will be taking a short break, maybe a 15-minute break. So be back around 10:20, and Guy will be going through the aerospace presentation. Thank you. Okay, Guy, you want to start?
Yep.
Okay.
Merci, Shirley. Good morning, and thank you for being here this morning at our Bombardier Investor Day. I've tried to structure my presentation, like André, into three sections. First section, I'll talk about where we stand today in the industry, a little bit of our position. Then I want to give you some examples on our value proposition. Not all of them, but just a couple of areas to show you how we're trying to better position ourselves in the future, and then what could be the result of that in the last part. I'm going to digress on purpose on some of my slides to try and answer what I anticipate will be some of your questions, but I'm sure I'll still get them at the end. But I will try and answer many of them ahead of time. Okay, so be patient. A little bit about the market and what we've been winning in the market. On the business aircraft side, we've been doing very, very well, even during the tough economic times, particularly with our wide bodies. I think we're well established as a global player. We're well positioned geographically. I'm very pleased with the distribution of our orders, so there's no real weakness in any parts of the world. Our new products like the Lear 85, the 7000, 8000 have been doing extremely well. I gave you examples on this chart of some of the larger orders, but it's continued to do very well. We're also getting good success with the current products in every part of the world, primarily, again, with the wide bodies, the Challenger and the global brands. A little bit less with the Learjet because it's a tough market right now. And if I look over the last 6 quarters, we've basically amassed or won about 46 or 47% of all the orders that were available in the segments that we compete in business aircraft. So you'll see that we're increasing share. Of course, the pie is smaller, but we've been very successful in getting a lot of orders, in those areas that we compete. Now, if I look at the commercial side of the house, I'll start with the C-Series. For the C-Series, we're very pleased with our position. I get a lot of questions about the order book, and are we okay, and are you going to win more, are you going to win big ones, etc. Realizing what our ramp-up will be, what our availability of aircraft is going to be, and our goals that we have in terms of diversifying our customer base, I'm very pleased where we are right now. We have about 300 aircraft or more that are committed when you consider the firm aircraft, the options, and the LOIs that we just announced. If you look at the customer diversity base, we have 10 customers so far. We said we wanted to have about 20 to 30 before EIS. We still have 2 years before EIS. If you look at where those customers are, we got customers in Germany for the C-Series, Ireland, Sweden, Turkey, and undisclosed in Europe that we'll be disclosing hopefully shortly, Russia, the U.S., Korea, and 2 more in another region that hopefully we'll be able to disclose shortly when the customer's ready. So we're pleased with our position on the order book with the C-Series. I mentioned a couple of calls ago that we had 4 or 5. We've talked about 2 of them since that time. In Dubai, we announced, Atlas Jet from Turkey that we have an LOI. We're working on firming that up as a PA. We also announced IFC, which is a lessor in Russia, which will help us, penetrate that market. So you can see that we're tackling most regions. We don't have anything yet in China. We're working really hard on that, and we have a couple of other things that we're working on. But we really want to make sure that we have that geographical and type diversity. Now, I want to talk about regional aircraft because I know that's a question that's on your mind. It's also a concern of mine. We haven't done well this year, so I want to talk a little bit about why, what we're doing about it. If you look at our competitors, they've done better than us, both ATR and Embraer, and we haven't done very well in terms of order intake for the last 12, 15 months, primarily the last 12 months. What I'm going to explain here are not excuses, so I just want to tell you what we feel are the reasons and, what more importantly, what we're doing about them. But our strengths for both the CRJ and the Q400 are mainly in the U.S. and the European market. That's where we have the largest incumbency, and that's where the products are mostly designed for, and that's where we've been the most successful over time. There hasn't been much awarded in those two markets. If you look even at our competitors, not much has been awarded in those areas, except for maybe options that have been converted to firm, but not much more than that. So very few orders in the two markets where we've typically won. Both ATR and Embraer have a solid, geographical diversity of customer base. We don't, not as well, at least in the emerging markets. They're stronger than us in the emerging markets. We recognize that. I'll tell you what we're doing about that, but I think that's stating the facts today. So they've been winning in those areas. That's where the orders have been given out. If you look at the list of the wins, that's where it's mostly been won in the last year and a half. Also, we haven't had, because most of our business was done in Europe and the U.S., we haven't used lessors a lot, for our products, for the CRJs and Q400s. Some of that is due to diversity of customer base. Some of that is due because of the type of buyers we were dealing with in those two, more mature markets. Embraer and ATR have used lessors a lot and operating leases a lot to win. So we're not well equipped to win in the developed regions because of that. We haven't been able to offer very attractive operating leases, to sell in these kinds of markets where the customers can't afford to buy. So that's another area that differentiates us. I guess another point, if you look at Embraer, what they've been selling is the 190. That's really what's been selling. The great majority, over 80% of what they've sold is the 190. They were alone. We didn't have anything in the 100-seat category. Now we have something. We introduced the CRJ 1000, at the end of 2010. It's a very competitive product. I'll talk about it. So it's going to be a bit more difficult to just take it all going forward in that segment. And then finally, if you look at the CRJ 1000, it's extremely competitive, even in those emerging markets where there's not scope clauses. So I'll talk more about that. So what are we doing? Well, we did introduce the 1000, okay, and it's a very good product. I'll show you a little bit more about that product later on. In the last 9 months, we've doubled our sales force in the commercial aircraft group. Okay, so we've doubled what we had at the beginning of this year. And all of this addition has been in emerging markets. Not only are we adding, but we're actually positioning and relocating people and hiring people in those regions that know the regions. We're doing the same thing with our marketing team. So we're redeploying marketing team. We're adding people. We're redeploying into the regions. And the same for structured finance. Now, we already had some people in the regions. It's not like we had zero, but we were not very, very competitive when you compare. So we've added a lot of resources in that regard. We've clearly delineated regions and accountability and goals. Simple stuff, but it's very clear right now who's got ownership of which regions in the commercial aircraft and how we're going about it and how we're going to tackle those opportunities. We've also dedicated resources to developing lessors and operating leases, and we've been successful in improving that in the last year. So right now, as an example, when we go out in campaign, we actually have operating leases, okay, that we can offer with our products in those regions where maybe people are not buying. We have definitely taken on the diversification of our customer base and also adding those lessors. We have had a few wins, not a lot, but starting to show some results. SpiceJet was one of those. Smart Aviation in Egypt was another one. If you look at the CRJ 900 win in China, the undisclosed customer was another example. We hadn't won a CRJ in China for over 8 years. So now we're starting to penetrate for the first time. So we have, as I mentioned, 3 or 4 lessors. We'd like to have more, but at least we're starting that are willing to offer operating leases for both the CRJs and the Q400s. So as a consequence of this, right now, as I stand, when I look at our pipeline of opportunities for commercial aircraft, not just C-Series, but for the sustaining products, it's in the best shape it's been in the last 6 years. So I'm not saying we're going to convert every one of those, but I feel much better about the real pipeline that we have and where those opportunities are in the process, whether they're proposals signed with cash or LOIs that we're willing to convert into PAs or we're about to convert PAs. So I feel much better. So hopefully we'll be able to show you the results of that in the coming weeks and months. Okay, so we'll have to see. We still have to convert. It's very difficult to convert right now in this market. It's very challenging. The customers are very skittish. Financing is difficult to go get. We've got a great partnership with the ECAs and now with lessors that is helping us, but it's still a very challenging environment. In the meantime, we've taken action on our production rates. You know that. We did that in the fall so that we could realign our production rates with demand. So supply is going to be aligned with demand next year. It'll be a very difficult year, but we feel we'll be aligned for the backlogs that we have. So we'll give you delivery guidance. As Pierre mentioned earlier, at the beginning of the year, you'll get a sense of where we're going with the commercial aircraft, but that's sort of what we've been doing, and I feel much better about what's coming in the pipeline, so we should see some of the results of that in our backlog. Speaking of the backlog, it increased in Q3 up to $22 billion, $22.3 billion versus the $19 billion it was at the beginning of the year. Most of that increase was due to C-Series and the new Global and also the Global platform. So that's where most of the gain came from. However, we're still doing well in most of the product lines except for the low end on the business jets. Still tough, hand to mouth, but we know how to function with the 6-month backlog. We've been doing it now for a few years. I think we've got good alignment between our production and the requirements in the marketplace. We don't see that increasing in the short run. It's still very challenging. On the challenges, a little bit lower than we'd like, but that gives us positions to deal with and to afford, and I feel good about the 300, 605. I think you'll see us replenish that pretty quickly. We are not seeing a huge weakness. The pipeline for challengers is still very good. Probably where there's a challenge there is mostly on price. Globals, you know the story, we're very solid, and I think I talked about the story on the regionals. Now the regionals, when we adjust our production line rates, the backlog, of course, won't be used as fast, so it'll be lasting a bit longer, gives us a bit of runway, to get it back. So looking at market share, if you look at our business aircraft, I mentioned what we've been doing in terms of order intake. You can see that as of 9 months year to date, we're at 37% on a revenue basis. Very, very solid, well-positioned. 2 major players, when you look at the industry, basically Gulfstream and ourselves on a revenue basis. If you look at deliveries, we're number 1 as well at about 33% so far with numbers of aircraft delivered. But on the revenue, I think it's more meaningful when we talk about this kind of stuff. If you look at our regional aircraft, on a delivery basis, this is not looking forward, but what we've delivered, we've held our market share, but obviously this is going to change going forward as we adjust the line rates. We will lose share. We have confidence that we'll be able to get back to about a third, roughly maybe 30% for the CRJ brand, and close to half on the Q400s like we've been able to maintain over time. In terms of what we're doing for the future, I want to talk a little bit about investment. Got a lot of questions this morning at breakfast during break about the investment. Are we doing the right thing, et cetera, et cetera. And we feel we are. We are replenishing our portfolio, refreshing our portfolio. It is taking a toll on the company because it's requiring a lot of effort, a lot of cash in the short run. And these programs are not a one-year kind of affair. It takes 3, 4, 5, 6 years to develop a product or to do a derivative. So it's a major kind of investment, and we're doing a lot at this time. It's tough in this environment, and we'll talk a little bit later about cash flow and how we're trying to manage through this. But we feel it's very key for the recovery and for what we want the aerospace group to be in the future. I'll talk about that, and Pierre is going to talk about that. We did introduce the 1000 at the end of last year. It's been successful. We'll see some of the benefits of that in the marketplace. It's a very, very competitive aircraft. I'll show you in a couple of slides how that looks. And basically, the other program that's short-term is the Global Vision, which is the fusion avionics from Rockwell Collins. That was committed and scheduled to be entered in service in the first quarter of 2012, and we will do that. So we're on track to do that, and we will be going with the EIS in the first quarter. In fact, we may be able to be a little bit ahead of that, and I'll talk about that in a minute. Now, looking at a chart similar to what Pierre-Alain showed you earlier, but I wanted to show you that we can be a cash machine. Okay? When we're investing at low levels and we have relatively good environment, we can generate ample free cash flow, and you can see over time here in the years where we didn't necessarily invest a whole bunch and where we had a lot of order intake and higher deliveries, we were in a very good position from a free cash flow perspective. Since the recession, we've essentially been about break even. We've had 2010 fiscal year where we did use cash. The other 2 years we broke even or a little surplus. And in 2011 calendar, we've already told you we'll use cash, mainly because we're not getting the advances we anticipated. But all in all, our goal is essentially to self-fund ourselves. That's our goal. And as we get volume, we should do better than that, even with the investment. But right now, in this environment, at these levels of productions of 240, 250 aircraft, we're trying to self-fund. And the organization has learned, how to function in that environment. I think we've shown it now for enough years that we're able to go get some cash within the operations, within, the customer base to try and cover our expenses. We expect, the spending to keep going for a few more years because of where we are with the Lear D5, where we are with the C-Series. One thing that we are doing, and it is helping us on cash flow generation, is getting leaner and really attacking the execution side of the house. And I just wanted to show you a couple of indicators. I could show you many others, but basically these are examples of how we are improving how the machine is converting, what we're using in terms of resources. One of them is the missed departures, which is called dispatch reliability. We're improving dramatically. You see a 32-point improvement, over the last 2 to 3 years. It's hugely important for our customers. Our aircrafts are becoming more reliable. They're able to leave with the aircraft, take off with the aircraft when they want to, almost a third more than they used to just a couple of years ago. If you look below that, part shortages, that's an indicator of the supply chain. We used to have very, very large amounts of shortages into our lines, created a lot of disruption, a lot of inefficiencies. You can see we've reduced that by 90%. It's not perfect yet, but it's a manageable level right now where we have very, very good stability. What we've done is driven, our expectations in the supply chain, which is a little bit different in this industry, okay, and different mindset. If you look at on-time delivery, we've increased by 53 points. Not so long ago, we were delivering about 37% of the time, on time. Last quarter, we were at 90% on time. I think we can get to 95%. After that, the marginal return is probably not as high to invest. But our customers, again, an indicator of how the machine is working inside to deliver, with the assets, the people, the money we're using. Finally, hours traveled work. What that is basically building the job in station, building the airplane where it should be built as opposed to moving it and building at the end of the line. And you can see the amount of reduction on traveled work. Another indicator of how we're leaning out and getting quality first time, getting productivity of our workforce. Though these are all important indicators that are telling you where we're getting some of that working capital improvement so we can fund, not just from the outside because our revenues are quite low. This past year has affected our business in many different ways. I'm not going to read the slide. The packages are for you. But basically, we've been able to weather the storm relatively well with our business aircraft. It's been challenging at the low end, no doubt. But overall, the business aircraft has done well, especially when I compare it to the competition. Commercial aircraft was tough. Regional aircraft, we haven't done as well. So we are taking some action. I think 12 will see some pretty big improvement. Now, we've been able to survive because we had backlog, but we're in for a tougher 2012, and we're taking action to redress that. And the other area that I don't talk a lot about, that I'll talk a little bit about today, is the services area. Been very successful for us. We've organized ourselves to take advantage of this in the marketplace. We see huge opportunity, very good margins in this area. So I'll mention a few of those areas of opportunity because we don't often talk about that. But it's been a good year for us in that segment of the business. As André mentioned, for us, cash flow is a big challenge. Obviously, we use a lot of cash of the company. We're conscious of that. So we've got a lot of initiatives. I'll just summarize. You can read the bullets by saying that essentially the organization is conscious of this. We've got everyone focused on maximizing each dollar so that we don't waste any money. In fact, even on the investments, we've looked at how we can push things to the right, without affecting the programs and try to make sure that we spend in the best way possible because revenue is not what we expect it to be at this time when we laid out our plan a couple of years ago. So the organization is well attuned, right down to the hourly person on the floor that understands the ramifications of cash and how we can manage cash better. So I'm going to shift in a couple of examples on value proposition. There's many, but I'm just going to touch on 3 of them. Essentially talk about our portfolio of products. It's very well balanced and what we're doing about it and how competitive it is. I'll talk about the services I mentioned, and then I'll just talk a little bit about the globalization of the company, but also how we're getting more local in each one of the parts of the world that we're doing business in. So I'll start with commercial aircraft. Basically, commercial aircraft is using 2 major levers to compete. If you look at first lever, it's on fuel efficiency, cost savings, and basically performance or value for the customer. And then the second area is we offer greener products, which is going to be in demand in most markets going forward, particularly as fuel prices go up, but on top of that, as environmental consciousness increases in the world. So I want to show you a couple of examples of that. I'll start with the C-Series. I think the C-Series, and you've heard a lot about this, read a lot, so I'll try to stay high level here, but basically 3 different appeals. If you look at the operator or the airline appeal, obviously the value, the performance, the cost I talked about, 20% fuel advantage, 15% cash operating costs better than what's existing today, a large, quite an extensive range, almost 3,000 nautical miles, very, very good performance, hot and high, and if you think of China as an example, huge differentiator for our aircraft. And then finally, short range, short airfield performance, taking off from London with a full load, those kinds of things are huge, for operators. So offers a lot of advantages, to the operator, to the airlines, and different types, of airlines. The second area is passenger appeal. And if you haven't been in our mock-up, I know some of you have been. We were there in Dubai. We actually had our demo cockpit. Fantastic aircraft. We had unbelievable people come and visit through it. But some things you may not know, besides the fact that it's the most modern interior with a wide body feel and a narrow body, little details, okay? Seats. The seats are 1.5 inch wider than a 737 in our aircraft. The middle one is 2 inches wider than the 737. We have 25 to 30% more luggage space per passenger. So almost 90% of all the passengers in the C-Series can actually bring their bag on board and have room for it. Huge differentiator. Not only that, on one side of the aircraft, we have the 3 seats. The bins are equivalent to 777 bins. So you don't put just the small bags, but the illegal bags, if you can get them on, you can get them in there. Okay, the big ones, they fit. Okay, airlines can charge for that. We had people in the Middle East say, we can charge for that. Okay, this is a differentiator if we're able to get the customer to pay to bring their big bag. Okay, so it's not a small thing. On the other side, the bins are the same size as a 737 or a 320. So little things, but are very important. The windows are as big as a 777, and you don't have to go down to look outside. They're actually big and centered and right where the aisle is. So every single row of seat has a window. So little things that really adds to the special comfort. The size of the cabin itself is really a wide body and a narrow body kind of aircraft. So it's huge for the passenger appeal. Community appeal. I think you know most of this, but 20% better on CO2, 50% better on NOx. The footprint, this is an example of the landing footprint for noise, in Montreal. We could do this in any airport. 4 times quieter. This is why we sold the aircraft in Sweden to Malmo, to Brothens. It was the only aircraft that could do this. In London City, you can imagine, okay, with this footprint, the differentiator is. So many airports and more airports in the future will require this kind of performance. So this aircraft appeals to many different types of operators, many different types of customers, in many different settings. And I think it's important to remember that. Now, it's also light. It's very light. Okay, when you compare a CS300 with a Neo, 12,000 pounds lighter. The performance does not just come from the engine. Half of it comes from the engine. The other half comes from the rest of the aircraft. Okay, the airframe itself, the technology that we're putting in the aircraft. It's extremely important. Little tidbits that maybe you don't know. We estimate there's about 485 out of production aircraft still out there that will be replaced. Aircraft like MD-87s, MD-83s, 737-500s, 737-300s, okay? On the MDs, we're 70% more fuel efficient, 30% more fuel efficient on the 737-5 and 300s. Huge numbers, okay? Huge numbers. The next chart, more of a comparison on the current aircraft, okay? You've seen these numbers, but I'll give you some more numbers that are not on the chart. You can see the comparison on the CS300 versus the Neo, okay, versus the MAX. Well, sorry, not the MAX, because we don't have the MAX on the chart. But the MAX, we estimate, because no one knows yet, what the engine's going to be like. They haven't said how heavy the aircraft is going to be yet, but we estimate about double-digit improvement on fuel efficiency and cash operating costs versus the MAX. But we'll know for sure when they become more public. But the CS100, little tidbits, against the 318, 22% more fuel efficient, 16% on a per seat basis, cash operating costs. Against the 737, 600, 20% per seat, 13%. These are huge numbers in airline business. Now the 195, I read somewhere that the Embraer is going to kill the C-100, okay? So I just want to give you some numbers, okay? Because we know that aircraft quite well. We compete with it in the market. The 195, which can compete on the seat basis with the 100, 22% less efficient, okay, per seat on fuels. A lot more per trip, okay? 15% cash operating cost less efficient. It's only a 4 abreast, by the way, I'll remind you. We're 5 abreast, okay? So even if they re-engine, even if they change the aircraft, okay, it's going to be a 4 abreast, all right? And it's going to be the aircraft it is today. So we will be very competitive. We're very pleased, very, very happy with the decisions our competitors have taken right now. We will be the only all-new aircraft in this segment probably for the next 10 years. And we need to capitalize on that. One last word on the 190, because I did mention the 190. We don't run into the 190 when we compete. Very, very rarely when we compete with the CS100. Very rarely. Today we have a CRJ 1000. That's what we compete with. And I'd like to show you a little bit, about that in a couple of slides on how the CRJ 1000 competes against the 190, because again, I read somewhere that the CS100 is dead because the 190 is going to re-engine. First thing they'll have to do is catch up to the 1000, and you'll see that in a minute. But a little bit on the timing of the program, the development of the program. Okay, we're making good progress. Lots of talk, lots of stuff written on the CS100, CS300. Are we going to be on time? Where are we? Et cetera, et cetera. We're making great progress on the engine. There's a second engine that's about to be tested. So we're perhaps right on track in terms of their engines. And all the results we've seen so far are what we expected with the engine, if not a little bit better. We have had the final results of all the wind tunnel testing. We've had 3 different cycles. It's confirmed the aerodynamics of the airframe, so we know it will perform like we expect. So the engine will perform like we expect. The airframe is supposed to perform according to wind tunnels, so we're very confident that the plane will deliver. And the weight, by the way, is on track, marginally off. So we don't have huge levers here that are going to change the performance of the aircraft. We've got facilities that are on track, whether it's in Belfast, whether it's in China, whether it's in Saint-Laurent, Mirabel. All the facilities are on track per the time. We got rigs coming in our Siesta building, which is where we're doing the electrical or all of the virtual airplane testing on the ground. We'll have a system on test by Christmas, okay, the first one. And sometime in the first quarter, most of the systems will start coming in and start to be tested. You can go visit. It's there. You can see it. I was there a few weeks ago. You can see the virtual aircraft right there. So we're going to be starting to test here at Christmas, and then more significantly in the first quarter and second quarter. And then finally, we are building some production parts. We're not quite done on all the drawings. Some drawings still to be done. But on some parts, we're completing, and we're building some production parts. So we are still driving for 2013 entry in service. Do we have issues? Yes. Do we have compression? Yes. Do we have challenges? Yes. And in several areas. Do we still believe we can make it? Yes. Okay? And we're looking at how to compress because we have moving parts. Some of them are behind, some of them are ahead, and how can we maximize all of that, put that together to get the aircraft EIS in 2013. A little bit about the CRJ 1000. Again, I want to address this a little bit about the competition and the competitiveness of the 1000. When you think CRJs, you should be thinking economics. It's a different aircraft. It's a little bit narrower, okay, than the competition. You should be thinking economics. You should be thinking fuel efficiency. You should be thinking light aircraft. And you should be thinking money machine. Okay? We can show the airline customers that we can make money, a lot more money, okay, against the E-Jet. And we have head-to-head campaigns right now where we're competing with the 190, and we can show dramatic improvements. Now, it doesn't meet all the requirements. The cabin is different. I realize that. The range is different. So it doesn't match in every respect. But when you want to make money in certain segments, the CRJ 1000, you can look at the numbers here. I won't repeat them. Okay? But these are numbers apples to apples. The only thing that's not on this chart is the fact that the plane weighs 10,500 pounds more, apples to apples. And that's the ERJ weighs more, okay? Not the other way around. Okay? 10,500 pounds more. That is a physical thing that has to be dealt with that cannot be overcome when you're flying. The 900 just a little bit on the 900 against the 175, 11% fuel efficiency improvement per trip versus the 175. And on a cash operating cost, 7.5% better. So again, I want you to think money machine, and that's how we're going to compete in the marketplace. That's how we've been competing. Not a lot of orders are being given out right now. We've sold 580 plus, 70 seaters and 90 seaters, the 700 900s, versus about 330 of the competition products for the ERJs. Okay, so that gives you a magnitude. There's no reason that the 1000 can start balancing out, okay, against the 190 now that we have a competitive offering. And I'm telling you this because I want you to know how we feel about our regional products, because people are saying, that we're abandoning them and that we're not in the business anymore. And that's not how we're portraying ourselves to our customers. And that's not how you're going to see us, in 12, 13, 14. Q400, just a few facts here against the 72, ATR 72. Different aircraft. One of them is more of a premium aircraft with more space, faster speed, more luxury, a lot more technology. Caters typically more to the U.S. and the European market, granted. The other one is less, costs less money, $2 million, $2.5 million less. So when we are competing against the very price-conscious guys, it's a struggle. But there is a market for this. And historically, there's been a 50% market. And there should be a 50% market going forward. Just a few other facts. ATR hasn't sold, one aircraft in the U.S. in the last 10 years. It is not a jetway-compatible aircraft. In some markets, that's very important. Loads from the back door. When you have the back door open and the service door in the back, they don't have an APU. You have to run one engine to keep the airplane cold or hot. If you've ever been in one, you'll understand what I'm talking about. So some markets are okay with that. A lot of markets don't want that. They need the speed also to replace the jets. So Q400 is not done. It's a very competitive aircraft, and we will sell the Q400. Okay. Just shifting gears a little bit on the business aircraft side. I think I talked a lot. I'll go quickly. But what we're offering in the business aircraft side, I think, is very compelling. If you look at the global family, whether it's the 5,000, 6,000, very, very solid. We're continuing. There were some people who were concerned that once we introduced 7,000, 8,000, we stopped selling. That's not the case. On the contrary, we don't have enough slots until we start the 7,000, 8,000. So there is a market for the 5,000, 6,000 going on. Very successful, the 7,000, 8,000. We don't divulge the order intake. I can tell you it's a significant portion of our backlog, and we are getting lots of orders and a lot of people that want those positions. So a very compelling product. Now, I just want to talk a little bit about the 7,000, 8,000 because it's starting. Basically, it's program development. Suffice it to say that we got some information on this slide, but basically we're on track with getting the suppliers and going through the JCDP. So there's no major issue right now in development of this program. We feel pretty good. And when we look at what we've been able to sign up, there was so much eagerness to be on this program that we were able to leverage our position quite significantly, with all our partners. So I'll just leave it at that. So it's a very advantageous aircraft for us. I talked briefly about the Global Vision flight deck. This is coming out in Q1 per the schedule, per our commitments to the customer. In fact, we may be able to get one in Q4. There's still 2 more weeks, and we're trying to get one delivered in Q4, which would be ahead of schedule. So the guys are trying to get that done. This is very important for us, this particular program. We're the first to develop the Fusion, the Fusion avionics suite for Rockwell. They're going to use it with other customers, but we're also going to use it extensively. It's basically the same avionics suite that goes on the Lear 85, and it's also the same basic architecture that's going to go in the C-Series. So having done this on the Global, it was challenging, demanding. We had some lateness in the software, and all the things that you may have read about was true. We got back on track, but this is going to help us a lot on our new programs. The C-Series and Lear 85 haven't gone through this pain. Okay? A little bit about our product portfolio and how it matches up, with a segment that's becoming more and more important. That is, charter operators, jet card providers, or fractionals. That's becoming about a 10-20% of all the demand in the business jets. And I wanted to show you some of the customers that we have for each one of our brands in this area. And this is an area that we're attacking more aggressively because we feel there's huge opportunities. Obviously, you heard a lot about NetJets. But there are other big ones out there, VistaJet and so on, FlexJet. They're big operators with lots of opportunities for us. And we're right there. A little bit on the Lear 85 program. Obviously, it's a challenging program. I had the question this morning at breakfast. The biggest challenge in Lear 85 is not the aircraft itself. We're not taking a lot of risk on the systems, on the engine. I mean, we're pretty well in control. Where the big risk is on development of the composite technology. Not so much that we can't build one, but can we build, every 2 days, every 3 days? That's the big challenge. A lot of invention. Someone called it a science project. That's a little bit too much for me, but there is a lot of innovation going into it. And during the process, during the program development, we lost for a while the ability, to stay in control and to meet the porosity requirements. We're back on track. We really narrowed down all the parameters. We feel good right now that we have the manufacturing process and also at the supplier that supplies the material, the controls that are necessary so we can build in quantity. So right now we're at the stage where we've moved on from the drawings. We're actually building production parts. We're putting together the first test vehicle. So that's what we're doing right now in Mexico, soon to be delivered into Wichita, and then obviously put it together and hopefully fly. So that's where we are. The EIS for the Lear 85 is still targeted for 2013, so we're feeling good about the 2013 EIS for this program. One last thing before I go into my last section, on the greener products for business jets, not just on the commercial side that we're doing this, but we're also heavily involved, as a leader in the industry on business jets. A couple of years ago, we were the ones responsible for bringing all the players, all the companies, Gulfstream, Hawker, etc., Cessna, together so that we could agree on some norms for the business jet industry as when it comes to fuel efficiency and the carbon footprint. And we were leading that activity. These are the goals that were set. The reason I bring this up is because we feel it's a competitive advantage for us. Okay, we have products that are coming to market that will really, really differentiate us. The Lear 85 is one good example of that. Much, much more fuel efficient than what we have right now in our Lear portfolio. But another good example is the Global. You tend to think the bigger aircraft, of course it uses fuel. But look at the 7,000, 8,000 versus what we have today. Huge deltas in reductions. So we're not only selling the Global on range, comfort, value, we're selling it also, Mr. High Net Worth individual. You want to be green on top of that. It's important, okay, for image, for optics. So we're able to sell very, very efficient aircraft because of the wing, because of the new designs, fly-by-wire, etc. So it's another area that's important for us, and the Global is a good example. Lear 85 is also a very good example. Shifting into integrated services. This is an area we feel there's significant growth. I want to show you a little bit of the market potential. This is basically our aircraft in the field, not the competitions, just the Bombardier commercial and business jets out there and the opportunity for us to serve, the opportunity that we have in terms of business. Now, we don't break out our revenues and our share in this segment. I can tell you that we have well less than half of the opportunity, today. All right? So if you look at that little dotted line in 2011, you can see the market for us is roughly, if we only limit ourselves to Bombardier planes, about $4.5 billion, we have well less than half share of that. So we're doing a lot of things to try and change our position in that regard. Very, very large growth rates. Next 10 years, 8%. Over the 20-year period, 5%. So very good. And typically very good margins in this area. So it's something that we're focusing more and more on. What kinds of things are we doing to take advantage? Is really expanding our global footprint. Okay, whether it's training centers, whether it's depots so that we can channel our parts. We have to position ourselves for the customers. We haven't been very good, in being there for our customers. We sold a lot of stuff, outside of North America and Europe, but we weren't there. We're aggressively now changing that footprint. And you can see some examples here of where we are with our service centers. Today we have 9 wholly owned service centers and 56, authorized service providers. This is going to change over time. We're going to increase that. Some of that we'll probably want to have within our own fold. Okay, we just launched one in Amsterdam recently and one in the U.S. So you'll see more of that geographically outside of those 2 regions. But we'll also use a lot of the authorized service centers. Those are important because it gives us a channel for our parts, which is a very profitable part of our business. So again, expanding our footprint to serve our customers, but also take advantage of the revenue opportunities. This is just an example of kind of things we provide. And I won't belabor it because I want to leave time for questions, but these are the kind of things that we are doing, in terms of positioning ourselves to take advantage of the service area. We've developed and basically Pierre put in place before I got there, a new division, responsible for services, where we put all these business units together. So it's been there roughly 5-6 years now, and it's really getting traction. And we've got a lot of profitability, P&L accountability, in this area. It's not just serving the customer, but also making money. And it's starting to show some growth and some results of putting those people together. Quick thing on the customer. Can't show you anything without talking about customer service and how we're trying to get the customer engagement. These are surveys that we do essentially every year. We use Gallup to go survey a large sampling of our customers and see, are we improving? Are we serving you correctly? And you can see on the business jet side, we're almost at best in class. We haven't gotten the results of 11 yet. We'll get them in early January. And on commercial aircraft, we're improving, but we're still got a gap to best in class. So this is something that we're doing. We're not just putting some facilities out there and adding, but we're making sure also we're getting better at the same time for our customers. The third part of example of a value proposition is how we're globalizing the aerospace group. If you saw André's presentation, he's already very global. In comparison, we're not very global. We're very centric, in North America and a little bit in Europe. We have to globalize ourselves as more and more of our business comes from these other regions in the world, whether it's commercial or business jets. So we're trying to globalize ourselves as fast as possible within our constraints and basically developing some local partnerships and local presence. We got many examples of that. I've already talked about what we're doing with the sales force, with the business acquisition team. On the commercial side, I've talked about some of the footprint things we're doing. In terms of shows, this year alone, we were in 25 different air shows. So we're out there, to see our customers. Big ones, small ones, but we're out there a lot. And then from a marketing perspective, we're also associating ourselves with thought leaders. And examples of this, 3 of them are pictured here, but there's a 4th one. In China, if you know Lang Lang is a very popular figure. He's basically a virtuoso pianist, and basically he's an ambassador of our brand in China. Very successful one, by the way. In Russia, Valery Gergiev is not here, but he's a very well-renowned, orchestra, a maestro, and basically he's our brand ambassador in Russia. In North America, we just announced recently John Travolta. You know his background, and you know also that he's a really avid fan of aviation, aerospace. So he's a great representative for our Challenger brand. And we also have, Mr. Gary, who is basically a well-renowned architect. So slowly we're getting these ambassadors that represent us in the marketplace, and that will enhance the brand of our business jets. Another area that we're working hard on is our footprint. And again, this is just a sampling. You can read what we're doing with our facilities, but essentially every one of our sites in the world is going through transformation, is actually going through some investments, some changes, and some very significantly so. Some are not pictured here, but as an example, if you go on Côte Vertu in Montreal, if you've been there, that's where our completion center is for globals. Huge investment going on right now to improve capacity, increase capacity, and prepare ourselves not only for increased demand, but for the 7,000, 8,000. So we're basically touching every one of our sites. But I guess the more important part, and I think I was talking with one of your colleagues during break, the bigger change for me is not the brick and mortar. It's what's going inside, what's happening inside the plants. There's a major transformation with our workforce that's happening, as well as a cultural change. And this is really going to leverage what we're capable of doing going forward when it comes to execution and people going the extra mile to get things done for the customer. So that's a major change. If you have a chance, you come and see our facilities, you talk to our people, you will feel it. You will sense it. On the way back from Dubai, I was in the Dubai Air Show about 3 weeks ago. We stopped in Morocco. And basically, you may have read that we announced an investment in Morocco. Met with the Prime Minister, and it was quite an impressive gathering, had all his ministers there, and we signed the agreement to put a facility there. We haven't selected the city yet, but basically it's a $200 million investment that we'll spend over the next 8 years. It will create roughly 850 jobs. We'll start with very simple, structural assemblies, and then move on the learning curve. Very similar to what we did in Mexico. Today in Mexico, we have almost 2,000 employees. We'll have close to 3,000 with ER-85. Now, why Morocco? Morocco is extremely well positioned geographically, highly, technical and well-educated workforce, already have an aerospace cluster, and basically we're willing to be very supportive for us as an OEM establishing ourselves there. So a lot of good reasons for us to be there, and I think this will afford us an opportunity to migrate more of our footprint to low cost. This is even more competitive than Mexico, okay, head to head. So it's over time, it's another way for us to blend our costs from the mature sites, more expensive sites that got lots of technical expertise, into sites that offer us the low cost opportunities. Doing the same thing with our supply base. We're really pushing our supply base to expand. Most of our suppliers were in the US and a little bit in Europe, and you can see that that is changing over time in the locations of the plants. A good example is what's happening in Mexico. We have many suppliers now surrounding our facility right next door that are in the same complex, in the same area, same condominium, where we've got them attracted and they can reduce their costs, and we'll benefit from a BOM standpoint over time. So we're doing it with our own manufacturing cost and BOM cost, as well as trying to get the suppliers to do the same thing over time. So I'm just going to close here very quickly with a few comments of how we're positioning ourselves. Similar chart to what André showed. You can see that our market forecast over the next 20 years, and I combine business jets here with commercial aircraft, so it's a little bit not totally perfect, but total units, I wanted to give you a sense. The two major markets over the next 20 years will remain North America and Europe. Now we have some fast-growing ones like China, like Asia Pacific, but the two major markets will still be the largest markets, and we're well positioned in those markets. Now we're also taking action, as you heard, to try and be better positioned for the other emerging markets. If I talk about North America more specifically, it's going to be slow growth in a short run, but there will be some restructuring happening. A good example is what's happening with American. We view that as an opportunity. They have 47 of our CRJ700s, most efficient aircraft that they have right now in their regional fleet. We expect, as the restructuring goes forward, that maybe there'll be some scope clause changes, and they'll probably want to take care of some of the less efficient aircraft. We see some big opportunity with AMR once the restructuring moves forward. That's an example of what's happening in the U.S. Business aircraft, in the next 10 years, almost 10,000 aircraft in the U.S. or North America, including Canada, almost 5,000 commercial aircraft. Huge base of 50-seaters that we're the incumbent, that we have an opportunity to replace, either with Q400s or 700s and 900s, as we work through the scope clauses. So big replacement. There's going to be some upgauging happening, in North America. In Europe, in Europe, similar kind of story. We see that market taking more time to recover for obvious reasons. So probably less opportunity in the short run, particularly for the regionals there. We're seeing really good demand on the C-Series, but on the regionals, much more quiet in that area. But still, we're talking 4,000 aircraft business jets over the next 10 years, 400 a year. You look at our market share, and it gives you an idea of what's possible for us to go get in these markets. About 1,800 commercial aircraft. And basically, it's going to take longer, but they are looking for the more fuel-efficient type of aircraft, the greener aircraft, which we offer. So it's an opportunity for us. And we're also really going to capitalize on the service footprint because we're not very present in Europe. If I look at China, basically it will be the second largest country market, in the near, well, not the near term, I should say, but by 2030. So second after the U.S. by that time frame. And I think that we're quite heavily involved in aerospace in China. André has led the way. He's well established. He's doing extremely well. We're trying to emulate that in aerospace, and we are trying to position ourselves as a preferred partner. So we have things going on with AVIC from a supply chain standpoint as well as from a partner standpoint. We've also got some things that we're working on COMAC. All these activities are trying to best position us here in China to be a preferred partner and afford us the availability to take advantage of this market. And then finally in Asia Pacific, you can read the bullets on the charts, but we're starting to penetrate with places like India with SpiceJet. We now have 2 or 3 different operators that have realized the advantage of the Q400 versus the ATR. It was an all ATR market, and we've broken in. So now I think you'll see us, get a few more in India. And that's just an example of what can happen. Indonesia is another huge opportunity for us in terms of market. Final slide before the conclusion. In the last 25 years, we've introduced or launched 28 products. We know how to do products at Bombardier. We know how to execute products. In 2010, we just launched the CRJ 1000. In 2012, we'll launch the new Global Vision. In 13, the Lear 85. In 13, the CS 100. In 14, the CS 300. In 16, the Global 7000. And in 17, the Global 8000. And that's what you know about, okay? So basically, we've got a lot of product coming in the marketplace here. And we may not, have timed everything perfectly for spending the money, but I think we may be lucky in when the market's going to pick up. And we're going to have the product, to really compete in the marketplace. So as a summary, we feel at Aerospace that we've had a relatively solid performance financially, not stellar, but we've been solid and consistent, and we've been able to go and grind and get the margins and manage relatively well, our cash requirements, and we intend to do the same thing going forward. We've improved and really increased the focus on the customer base. I show you some physical things we're doing, but we're also doing some things with our people. We've made significant investments in our products, and most of them greener products, which will position us well going forward. I think we got solid improvement in operational, effectiveness and flawless execution. We've got our warts, we've got some issues, but in general, I think we're executing at a high level. And basically, we're globalizing the company, whether it's footprint, whether it's presence, which will position us, for where we believe the growth is going to be. So my belief is that we will be a different group, in the future, because we're positioning the group to be a very different company going forward. So that concludes my remarks. I'm more than glad to answer your questions. Thank you.
Thank you, Guy. Okay, we have a question, Noah.
Thanks. In thinking about next year's CRJ and Q400 production rates, if I look at the slide with months of production and just did the simple back-of-the-envelope math there, it would imply you have to cut Q400 more than in half and CRJ by a third. Presumably, you'll make some assumption for a pickup in demand, which you alluded to, and could choose to build inventory for future deliveries. Can you are those the right kind of order of magnitudes that you were thinking about, 50% and 30% types of cuts, or is it substantially less because of those other drivers?
I guess you're thinking in the right direction. The only thing I can say is that, we expect to win, some products. So in our skyline of assumptions, we're not, accepting zero. So you have to sort of guess what we're thinking in terms of what we think we can populate. But yes, we've had to take adjustments, and we'll be talking to you about that early next year to show you exactly what we guide on both of those lines. But the reductions have been taken. So some of that is having an impact a little bit in Q4, a little bit, but it's really going to start having the impact in the new year.
Okay, that's helpful. One follow-up on C-Series. Embraer recently discussed delaying the timeline on the legacy 500-450, and they cited the Parker-Hannifin fly-by-wire software challenges. Yep. And it's the same system on the C-Series. Are you seeing that as a challenge?
Well, first of all, it's the 450 to 500, okay, which is okay for us, all right? 1 year behind at least declared. Right. It is the same supplier. It's not the same system. Okay, it's the same supplier. We're all over Parker. I can tell you that. Okay. Like, they feel the love.
So you don't see that as a huge, huge hurdle for you then?
It's the extra. Indifferent of what happened at Embraer. Fly-by-wire for us is a huge challenge. Okay, we've had fly-by-wire in some parts of the aircraft in the past, not much. So we're learning on this. Okay, so indifferent of what's happened, it's a big challenge, and that's why I jokingly said we're all over. Yep. This is one of the areas where we're spending the most amount of time, where we're really breaking down. I call them inch stones rather than milestones. Okay, we're measuring them in days on what they're supposed to do and whether they're on track, which they're not used to. So we're really, really all over this. And we learned a lot with the CRJ 1000, so we're trying to put that in place. We've hired resources from the outside, to help us, people that have done full systems, so that we have, the best chances possible here to minimize the risk.
Thank you.
Yeah, you're welcome.
Yes, Steve, sorry.
No problem. Good morning, Guy. Steve Trent from Citi. Just curious, and you touched on it a little bit. I'm curious about the relationship you've nurtured with China's COMAC. To what degree do you think that you've leveraged the success on the transportation side to get the strategic alliance going with COMAC? And I would contrast that with Embraer, which had a JV for a decade, which went in the wrong direction. What do you think you did differently than them?
Well, first of all, I think there's a lot of goodwill for Bombardier in general, in China because of transportation. Like I said, André's team has been very successful. We've been there a long time. So I think it really doesn't help us necessarily with the same stakeholders on the aerospace because they're not the same people. But I think there's goodwill, overarching goodwill. So that's point number one. Point number two, we're trying to develop relationships at all levels. One thing that some of our competitors have going for them is a high level, whether it's Mr. Obama or Mr. Sarkozy or Ms. Merkel or Lula and now Dilma Rousseff, I think her name is, the new president of Brazil. They have very good relationships, at the high levels. In Canada, we're starting to develop that. So this is some area that we've got to work on. I think our government has been very supportive of the C-Series, but we're a small country. We got to elevate that so we can get to that level, on that plane. And that's going to be challenging, but we're working on that. But I think the relationship with AVIC and COMAC is important in the sense, couple of senses. First of all, COMAC's been selected as the company that's going to do the jets, right? And they could easily, without us knowing, veto and say, no way, Jose, we're not going to allow any sales of a competitive product like the CRJ or we feel the C-Series is too close to the 919. So, we believe by having a partnership and develop things together, because we feel we're complementary to COMAC, by the way. We don't feel we're competitors. Okay, the C-Series is positioned here. The 919 is there. We feel we can help the situation that way. With AVIC, they're a huge player, in the aerospace industry, over 400,000 people, important supplier. So again, I think all of this is for us to develop the right relationships with the players. We'll see in the end if we have the right strategy. But so far we believe, and it's a long-term thing, right? It doesn't happen in one quarter and then suddenly everything opens up like the floodgates. It's going to take years. But we're seeing a warming up. And the CRJ 900 to this undisclosed customer was a little sign to us. And hopefully we'll be able to see some C-Series orders via secondary sign. Okay?
Perfect. Thank you.
Joe?
Guy, you talk a lot about the what the risks are, the contingency on the C-Series. I'm wondering what you are doing to mitigate larger implications of a delay if there is one, and particularly thinking about concurrency between design and production if you get into a design delay. So you haven't told us a ton about prospective production rates in the early years. I'm less concerned about the earnings in 2014 than I am about what happens if you're delayed by a year and you start making a bunch of airplanes that need a lot of rework. Yeah. So what can you tell us about that?
I'm not going to tell you a lot about that, Joe. So I'll just give you that preamble. But we have been thinking a lot about that. We have our own experience about mod lines, as an example. Pierre's got a lot of experience, and share a lot of that with me, and we've seen also what other OEMs have done. So we're taking that into big account. If ever, we were to incur a delay, how can we, satisfy the customers the quickest, versus, accumulating a whole bunch of working capital and having to redo these aircraft. So we have some ideas on how to deal with that. Part of that is also how we set up our skyline to start with, right? If you set it up in such a way that you were anticipating or smart enough to anticipate stuff could happen, you may be able to, you may have already in your plan something that took account some of that, okay? So that's also part of it. But we are going to be very careful in building mounts of inventory. We are going to try and satisfy, if ever that happens, okay, that satisfy customers, but for sure, we're not planning on that. Right now, we feel that we can meet the ramp. We feel that we can meet the customer requirements, and that's what we've driven the whole organization. But we're very conscious of the possibility of some aircraft being parked and how much that ties up money, and then the effort it takes to get them up. I mean, if you look at the Boeing 787, it's a huge, huge undertaking, and our company cannot afford that. So we're going to avoid that. Okay.
Can you, or what will you give us in terms of guidance? I guess in a couple months or a few months when you get to the fourth quarter in terms of cash utilization by the business for the year.
We are in the fourth quarter.
I'm talking about for next year.
Oh, what's your question?
Well, I'm trying to get my arms around when we're going to find out at various milestones along the way what your anticipated cash usage on the C series is going to be.
Well, it's basically part of our plan. So we're not going to give you 3 or 4 years outlook, of cash requirements unless Pierre says we're going to do that. And I doubt we're going to do that. We'll give you 1 year out, and that will comprehend anything that may happen with the C series. So you'll have a view of that, but we're not going to give you 14, 15, 16. Pierre, I don't think we have any intention of doing that. So I don't see that happening, Joe. Okay.
We have another question right in the back here. And I'll go to you guys after. No sound?
Sound work now? There it
Good.
goes.
Yeah.
Okay, George Ferguson with Bloomberg Industries. Can you speak to us about what the effect could be next year with European banks pulling out of the financing market or pulling back from the financing market? And as a second part of that question, can you talk to us about Export Bank Canada's capacity to continue to finance Bombardier deliveries?
Okay. Yep. Very good question. Very good question. First of all, we're very fortunate to have EDC, and they've been a great partner for us through the last 3 years. And we have not run out of capacity with them, and we don't anticipate that happening in the short horizon. Okay. Now I can't speak, for 14, 15, but I don't see that being a problem in 12. For the levels of business that we do. Now beyond that, we've been working very hard at developing other sources of capital. We have a structured finance team. Red is here. She's the leader of that group. We've been working on trying to pool some money, from China. So you've heard about ICBC, CDB. We've also trying to link with ECD. What is it? EGCD? Well, with the equivalent in the UK, whatever that is acronym. I'm sorry, I can't remember all these acronyms. But the equivalent in the UK, so that they can pool together with EDC and maybe diversify the risk. The other thing I mentioned that's important is the access to lessors and operating leases, which will help us. Typically we've basically sold the aircraft most of the time, within our regional, and now we're going to be taking more advantage of that, and we've been able to line up some people that are willing to do that. So that's sort of our strategy and how to tackle. But I don't see 2012 or 13 being a problem with that. It hasn't been, even for the C series so far. Okay. And for business aircraft, the sources of financing there are different. For companies, it's basically themselves with their own financial resources, and then for high net worth individuals, typically it's not so hard. Yeah. Okay.
Chris?
Sorry. Thanks. Just going back to the C Series program, if we could maybe delve into what we should expect over the next year in terms of sort of key milestones, even if you can sort of talk about testing and what the plan is for testing, and both who the design authorities may be and where that testing will take place. I'd assume it would be Wichita.
Yeah. C Series you're talking about?
C Series.
Yeah. I guess we've stayed away and given you some interim milestones because we are all worried. I'm very worried that you're going to just pick one date and say, wow, things move too much. We've given you an idea of the first flight, which is, we said, about a year before EIS, so that's a pretty good one to look at, and that's coming not so far away. I think that you'll You'll see us talk about some major milestones when maybe, I don't know, we ship a fuselage or wings from Belfast. I mentioned in my little speech what we're doing with testing. So we're going to have people visit, Siesta, so you'll be able to see which systems we're testing, on the ground. And we wanted that testing to be roughly 1 year. We can compress that. We've never done a full year, so this is added, mitigation for our program, but on the system. So that's where we're going to see, avionics, electrical system, fly-by-wire. So we will give you some of those, but to tell you in advance what the milestones are, I think, we just create a monster that we won't be able to manage. So we're not going to do that. Oh, the flight test program, yeah, it's going to be in Wichita, and we'll have some of that also in Canada and Mirabel. So we're going to divide.
Just to that point, do you have an idea how many aircraft will be actually involved in the flight test program, and is the expectation that those aircraft are going to go into
I don't remember
sale?
if we divulged that. Yeah, huh? Yeah, but no, but he's asking how many
Number
aircraft.
of test units.
Yeah, I know how many, but I don't think it's the normal number. Okay, so I'll just leave it at that. I don't want you to start counting.
And sorry, the expectation is you'll be selling them to customers
Yes,
after the fact?
that's our intention. We may keep one, and we'll sell the other ones. Yeah,
Okay,
because one of them is going to require longer-term testing. But
We
yes,
have
our intention
two
is to sell
Davids
them.
here in front. You always sit together, you guys?
Yeah, we get together on all our questions. Just more on the margin side. And I know in the past you've sort of divulged, how much you expect the delta. And I know you're not committing to the guidance on the 10% target or when that might be achieved. But I think you said in the past it's a couple of point in operational improvements. But when I look at that chart, which you've had very good progress, I guess my question would be, how much have you achieved to date in terms of cost savings, just on time delivery and things like that? And how much more juice can you get out of it? Because those charts look pretty good now. Especially related to the
that's
guidance.
a qualitative kind of assessment, and I'll give you that as a manufacturing guy. I would say that I'm more than halfway to where I would like to be in terms of clicking, perfectly in the plants. So maybe like 2/3 of the way there in terms of obtaining. The rest, it's not going to be necessarily things like improved delivery on time. We're already at 90%, but it's going to be more on reducing lead times now. It's going to be on accelerating the velocity in the plants, inventory turns. That's where the next, we already got some of that, but there's going to be more. And then obviously the leverage, the ratchet effect of volume, will give us some on some of the things that are not as easily movable. They're not, move. So I would say, if you ask me, I would say about 2/3 obtained of the operational effectiveness things. Now we're going to have to hold it as we increase volume, and we're going to be challenged. We have some lines that are going to go up, so the secret will be, can we hold this? And I'm less worried about holding internally than I am holding the supply chain. Okay? They're stressed, and that's going to be a big challenge because they can create a lot of disruption, and if they're not harmony with what we're doing. So this is why we're driving so much the quality. We've put a whole team of people now on supplier development, supply quality. We've done a whole bunch of things to try and improve the robustness, problem solving, and supply base to try and keep the gains. Because it doesn't matter how good you are in your four walls. If you're not getting the quality, if you're not getting them on time, it can disrupt everything. So I'm worried more about that than inside the four walls right now.
And how much, Guy, I think you said, like, of the 5 to 10% when you're sort of guiding to the 5%, I think you said in the past it was a couple of points on the EBIT margin could be from operational improvements.
I already gave you a sense of what about 2/3 I think we've achieved now. We're building, Pierre said, 240 aircraft. It's very low.
Right.
So it's tough.
And are we at is a 5% kind of, not to give guidance for next year, but is 5% kind of the low water mark now, given the operational improvements that you've had? It used to be 2.3, I think, in the last recession.
We'll get back to you.
All right.
We'll talk to you early in the year.
Okay.
Okay? Nice try.
Guy, I'm going to take another stab at it in a different way. When I think of margins for next year, it seems to me there's a number of factors that can drive it. mix, obviously, volume, price, foreign exchange, because presumably you're slowly edging into the higher dollar.
Yeah.
What should I be thinking about in terms of what are going to be predominant drivers here? Because I know you're not going to give me a number, but at least then I can think when I'm thinking about 2012 in terms of things to be worried about.
One big driver is obviously volume. Volume is a big driver for us, and for commercial aircraft, without giving you any guidance, there's a line that you can follow on volume, and after a while, it's hard to stay on that line as you reduce costs, right? So volume at a certain point is very important. If you cross that point, there's a lot more fixed costs on a ratio basis versus the revenue, okay? So volume is very important. Sustainability of business aircraft, our assumptions is very important for next year. So that's another area. Pricing, I think we have a pretty good feel for it, but it's got a hold. We're not being overly aggressive in our pricing assumptions, but that's a very important piece. Mix. Mix can go in our favor. If you get one Global versus 5 Learjets, or 3 Learjets, it's a big difference. So the number of Globals is very important. How we ramp up, with the new Global Vision in the first quarter, and we're going to have some challenges because we're starting, we're no more classics moving into Global Vision, so we'll have some challenges at the beginning, how we ramp up, how quickly. The greens are easy to do. It's once you convert them and get them certified, so we may have some challenges that. So all those things are factors that will give you a good sense in the beginning of the year once we've assessed it. My budget review is only tomorrow with Pierre, so I don't even know if it's going to be approved, okay? So I got to go through that first.
And just to follow up on that, you mentioned sustainability of business jets. So are you talking about volume here and whether you've actually sold the Skyline, or?
I think we're in pretty good shape, but we still have some to sell. I mean, it's not particularly on the Learjets, and some on Challengers we have to sell, but we're in pretty good shape. We pretty well know where we're going to be. If we had a big double dip, then that would be disastrous. We saw what happened when we had that. Even though we had sold all the aircraft, you had all kinds of cancellations. So we're not assuming that, but that would be a factor.
Okay, and just one broader question, something I've never really known, and maybe it's been given out in the past. I'm wondering, when you're thinking about new programs, whether it's Learjet 85 or C Series or whatever, what is does the company have a return on invested capital target? I'm assuming it does, but I should ask that. And what is it?
We have targets, and it's something you don't know and that you won't find out. We have targets, yes.
Why not? I mean, what's so secret about that?
Oh, well, because it's competitive information, and basically we feel it's something that we don't need to release.
But isn't it such a broad number that you're not going to really create a problem relative to the competitors on this?
Pierre is going to address that, I think, at the end. But basically, no, we're not going to tell you that number. But he'll address it. Yeah.
Okay, I'll come back to Hamza after. I'll come back to Walter before Hamza. I have a question from the web. A question from Mark Johnson regarding composite porosity problems with the Learjet 85. He's heard that, and he's asking, was that the fuselage or the wing?
The wing is an RTI technology. It's the same technology as the C Series. So the wing, is in good shape, and in fact, we're very pleased that we've just decided to pick that technology because we have a little bit of an advanced practice because the Lear 85 is ahead of the C Series. That was not the original design. When Grobe had the responsibility, had picked a different technology, but we shifted. As you know, that when they went bankrupt, we went and decided our own technology, redesigned the wing, and we got RTI, and that's the technology on the wing, and it's made in Belfast. The planks are made in Belfast, the spars are made in Belfast. The porosity issues we had was on the fuselage and some other parts, some large parts, which is a different technology.
And they're solved?
It's solved, yes.
It's solved.
It's resolved.
Okay.
We're passing right now. There's no issue, but we did have some issues during the development process.
Okay, thank you. Our next question is going to be from Walter.
Yeah, thanks very much. So I'd like to turn back on the C-Series from a demand perspective. I know that in past presentations you've highlighted that you're comfortable with the new order situation right now. You often pointed to the charts where you showed the historical product competitor, where new orders were at that point. We didn't see those charts today. I don't, if we were to overlay that, you mentioned 6 months ago it should be the time where we really see a ramp up in those new orders. We haven't seen them. My question to you is, you've made a very compelling case today for the advantages, and where is most of the pushback coming from your potential customers?
Well, first of all, we don't have pushback, but I think you have to see what kind of economy we're in. Okay, so that's point number one. Point number two, we need a certain amount of aircraft to feel comfortable with the program. And yeah, we could do a lot more if we gave them away. I shouldn't say that word, but if we went much deeper. But we feel there's value in the planes, so there's tension in those discussions, and we're going to make sure that we, once we are satisfied with the amount of people that are launching the aircraft, that we have the value and we get that value in terms of the pricing and the deals that we sign. So that's another part of the equation. Okay, and I guess the other piece. When I look at those curves, maybe I should have put them in my presentation because I have them. But basically, the only aircraft that is much, much in advance is the 787. But the other ones, the 190, the 320, the 737, we're right on track. Where we are right now at this point, 2 years before EIS and 3 years before the 300.
Your competition is sort of highlighting that it is perhaps too much aircraft with too much range for the seat capacity that you're offering. How would you respond to that?
I would say there's just not enough aircraft, okay, for what's required. I mean, what do you expect them to say? It's a great aircraft. They're certainly going to knock it down. Our customers are not saying that. I was with a customer yesterday, and the knock on the aircraft that they're dealing with right now is it didn't meet all their requirements for the range and what they wanted to do with it, and the aircraft wasn't flexible enough. And that's exactly it. I didn't have to say anything. I said, perfect. Okay, it works. Okay, here's what we got to offer.
One last quick question here. When is the earliest delivery out of all the customers you have in the book right now? What is the earliest delivery schedule?
Delivery?
Yeah.
First one, end of 2013.
So that's already, that slot is filled?
It's already sold.
Okay. Thank you very much.
We haven't disclosed the customers. One of those undisclosed, but it's already sold.
Great.
Yep. By the way, 14 is sold, 15 is sold, almost 2/3 of 16 is sold in the Skyline. Okay. So.
Yeah, on the RJ market, you talked about doubling your sales force, trying to get a bigger footprint in emerging market. How aggressively do you have to discount to get a bigger install base there? And then maybe on the services side, could you talk about the timeline there in terms of gaining share?
Yeah.
Thanks.
Well, it is tough right now in the emerging markets on pricing. So we have to be very aggressive in our value proposition. Obviously, we try to get the most possible for what we're offering. I mean, that's why I wanted to show you some of the value propositions, because we shouldn't give it all away, right? If we're going to save X amount of dollars to the carrier, we say, okay, you take some, we want to have some in our price for what we're offering you. But it is tough, and we're having to go low. Okay, so there's no question about that in this environment, in this market today. In terms of the services, we have been growing roughly, I believe, if I remember, François, maybe around 5% per year. Is that a good number, François? Roughly 5% per year, but you saw that there's about an 8% CAGR. So I feel I'm not at least maintaining, that rate. So we're pushing that organization to grow faster. And some of the things I showed you, but we're roughly growing about 5% right now, that element.
Okay, next question from Tim, and I'll take one more. Cameron didn't get his chance.
Just want to return to the C-Series and the market opportunity. In that size category, I think the C-Series has done reasonably well since it was initially offered into the market. But of course, a lot of the demand has come for the larger narrow bodies in the last year or two, and you've provided some thoughts in the past on why that is. What's happening in the market today, and do you have confidence that there will be, I don't know if a shift is the right word, but a pickup in demand for smaller, narrow bodies over the next couple of years? Because it's still the bulk of the orders, as we know, is going for the larger.
Well, our market forecast says over the next 20 years there's going to be 7,000 planes sold in this. So you could challenge us and say you're off by 40%. Right? You're off big number, 30% off. Even if we were off by 30% on that number, we still are in very good shape for the program. Okay, so that's point number one. Point number two, I just want to give you an example of where the market is. Middle East. I was in Dubai, and I'm going to be in Bahrain in January, okay? A place where they're buying a lot of planes and a lot of the wide bodies and the larger narrow bodies. They've never had anything else to buy. Okay? They've never had any other options. It was amazing to talk to the sheikhs and the CEOs over there. They've had no other options. So of course you buy a 320. Of course you buy a 321. What else are you going to buy? They don't buy CRJs. That's not their market. They want a plane that has that wide body feel in a narrow body with all the attributes I talked about, the wide seats, the luggage. They want the range. This is going to be a big region for us. And that's not the only region, but that's a huge opportunity for us. China, you look at the geography of China. You look at the topography of China. How many aircraft can do the missions, okay, hot and high, to the airports that they have with a full load? There are no options. There are options. How many aircraft can leave London City, full load? Okay? There are not many options. Those are just examples. There are no aircraft that could land in that airport from Malmo. They were going to shut down. They would have to move airports. This was the only aircraft that had the noise footprint to make it. There are operators out there that want to do cross-Atlantic with 42 seats, premium. Okay? That aircraft does it very efficiently. So I could give on examples and examples and examples. And that's why type of operator, geography, very important. I know you guys want us to get 200 orders with one customer. You'll be the first to criticize us that we use up our whole skyline with one guy and nobody wants, there's no residual value, nobody wants to, no place to put these aircraft. We are going to go and get those 30, 40 customers, and we're targeting them very carefully. So I don't know if I answered your question, but
I think so. So what I'm trying to clarify is, if you look at Boeing and Airbus and the larger narrow body market, their order intake this year, last year, is tracking ahead of long-term forecasts, whereas in the C-Series market, it's actually tracking below long-term forecasts. So if I'm understanding you correctly, it comes back to the fact that the C-Series is maybe available in the marketplace for a couple of years, and we're not at that point yet where the optimal solution is available.
First of all, C-Series, the CS300 will be available, end of 14. Right. Okay, still 3 years out. Secondly, I'm not building 42 a month right now. Okay? I'm not building 35 a month. You will get 400 or 500 orders a year if you're producing at that rate. And before we even sniff that rate, it's going to take a long time. That's not even our plan. Okay? That's not where we're heading. Now, I hope I have that problem, and I have to deal with 40 a month. But, the size of the orders we're going to get for our program are commensurate, with our build and our skyline and what we have planned. So
Okay, that's helpful then.
Okay.
It's really a question of the aircraft being available still or not available, as the case may be.
Yeah.
Thank you.
Okay.
The last question is going to come from Cameron.
Yeah, just a couple questions on the regional side. I guess, firstly, there was an airline in Indonesia that had an RFP out for regional jets, and CRJ-1000 was competing that. I just wonder if you can sort of talk about, I think we were supposed to have heard something from now. I'm just wondering if you can talk about what the status is there. And I guess secondly, maybe a bigger picture question on the regional aircraft. You've cited, a couple of opportunities, in the next 12 to 24 months. AMR is one. I guess maybe SkyWest is another potentially large one. Maybe you can talk about some other, specific customer RFPs that you're interested in that are out there, or perhaps, just geographically where you see the opportunities coming for the regional aircraft, both CRJs and Q400s.
Yeah, I guess the Indonesian customer you're referring to is called Garuda, okay? And basically, we'll have to wait till they announce. We know exactly where we stand. We are extremely competitive, and we'll just have to see when they're ready to make an announcement in this election. So we're eagerly awaiting. It's not that the campaign is stopped or anything like that, but they're going through their process and making the decision. In terms of opportunities, unfortunately, I can't give you ones that the customers have not made public. But SkyWest, they've talked about, yes, we're competing in that one very aggressively, and they're one of the big survivors, in the regionals in North America. And they happen to be our largest customer, so we have incumbency, so we're planning on doing well there once they make a decision. American, I mentioned, not because they're asking for aircraft, but, historically in our experience when there's restructuring, typically North American Airlines in particular will take advantage of that restructuring to improve their situation. And in the regionals, they happen to have CRJ 700s, and they're very effective with them, very profitable aircraft, and they have others that are less. So I expect that they will want to, improve their position as part of their restructuring. There are several right now in emerging markets for both the Q400. I mentioned India. I can't talk about customers because these are privileged, information, and if they're willing to talk about them, that's fine. But definitely India Indonesia is another one. In general, the emerging markets is going to be different for us. You will see, China and Spice and India SpiceJet were little tidbits, but you're going to see more of that, and it won't start like a big bang, but you'll see little drops here and there that show that we're now competing in those places. I think it's going to take longer in Europe. We have a few campaigns, but if you look, without naming any of the carriers there, most of them are not doing so hot, and they're pushing back. You can see what Lufthansa said, what Air France is going through, and so on. They're customers, but I don't think they're going to make any immediate decisions. And the same for the regional. I think in the U.S. we're seeing more activity, more requests, and I think also that you're going to see some of the major carriers address some of the scope clauses. If that's the case, we're going to have huge opportunities. And the final thing I'll say is on the Q400, because of fuel prices, we're seeing much more pull and requests for proposals to replace 50-seaters on the same kind of routes. And it's a very effective replacement depending on the stage length. If it's anything, 300 miles, 350 miles or less, it is much more effective than a jet, and a lot cheaper, a lot more fuel efficient. So that's another area where we're seeing, and I can't tell you which customers, but we have at least 3 or 4 right now that have approached us for that. So I'm sorry I can't be more specific, but I can't talk about specific companies right now.
Thank you, Guy.
Okay.
Now I'd like to invite Pierre to conclude. And I think I'm just going to stay here because you're going to be short. You don't have time. You don't have time to be long.
At the same time, I think you've seen many presentations. Let me start with your question on IRR. The reason we don't disclose per project is because I don't know what you would do with this figure. Because, of course, IRR will be influenced by how much financing we get from our suppliers, from governments. It also is influenced by whether we compromise sometimes on the margin short term and how much time we take for over the program. So given that we give you guidance per year, if we give you an IRR without giving you a lot more information, which all the variables in this world, we really cannot figure out, how we would give you an information that's valid for actually figuring out the profitability of the company long term. So I think this is something that maybe we can challenge each other and say, if this is information that could be useful in another facet than project by project, that's something we could look at. Where, as you know, we've shown you as much transparency as we think any public company does. In fact, in many cases, a lot more. But we want to give you useful information. So let me start. I don't want to repeat the presentation. I just want to give you, maybe I'll back up one. I give you a feeling of all the projects we've spoken about. What does that represent in terms of revenue for the company beyond 5 years? Or what does that represent from a revenue for the company in the next 5 years if we're talking about emerging countries. Of course, take that as directional, because it's very hard to predict. Year to year, we give you those guidance. But directional, when you think of Bombardier, what are the revenue size you could think about, and what are the margin size you could think about? We talk about execution. We talk about improvement of aerospace, the 8% target for transport. And I'm going to give you some general view of that and not necessarily pin it in 1 year, but I think it's a good view. First of all, from a product perspective, on this I've chosen to give you some aerospace number because transport's got such a wide portfolio, it'd be hard to give you each one of the products. On transport, we'll talk more about the geography. If we look at the C-Series, Giza said already 7,000 unit market over 20 years. And we feel that represents, over the medium term, 5 to 8 billion for Bombardier additional revenue, because that's a new market for us. I think this is a view in a very normal business case. Of course, there's a lot of more opportunities than that, and that amount of volume does not get us to the 50% market share. And I don't think, I've always been clear, this is not what we've put in our program. But with the level of investment that we're making, with the type of product we have, we think 5 to 8 billion is reasonable. Now, if we look at the global market, 2,200 units. So the market of wide-body aircraft, large, super large aircraft, doubling in the next 10 years. And we can demonstrate why. The amounts of billionaires will double. The amounts of global companies will grow substantially. We see the profile of who's buying these aircraft in emerging countries. And we feel that this market, as an industry, this is not only Bombardier, but as an industry, that category of market will double. And just maintaining the market share we have in the global market today, given that we have the new products that we're working on, this is a 1.5 to 2 billion additional sales in that category. So that's also a significant growth opportunity for the company. And now if we look at the Lear 85. Lear 85 is in a market of a small to medium-sized airplane of 4,600 units. But this is a new category for us. We're going against the Sovereign for the first time, because the Sovereign, as we know, is a little bit bigger than the Lear 60, and the Lear 85 is really in between the Challenger 300 and a little bit more performance than the Sovereigns and a little bit bigger aircraft. So if we look at that category and we just simply apply the market share that we target in Learjet, because we're not quite there in market share in all of our product, but this is a modern aircraft, an aircraft that has a competitive advantage. This is a $1 to $1.5 billion opportunity for us. Now, if we look in terms of transport, you know that we have a very wide product portfolio. And this product portfolio gives us a huge advantage in different markets. And I'm going to talk about volume more related to emerging market. And it's not that I want to say there's no volume opportunities in North America and Europe, but just to give you a sense of the markets we're going after in developing market. Regional trains, for example. In China, we talk about high-speed train. We talk about metros, how they've built infrastructure for the cities, and that will continue to expand. But we haven't even begun in China to address regional trains. Trains that connect these very big cities together. In reality, you can't cover all the suburbs with metros. You need regional trains to cover these very wide regions. And this is an area where Bombardier is a leader, and Bombardier can contribute a lot to this market. Another area we can think about that we've been talking about for a long time is locomotives in India. We know there's 2 large bids. It's a little bit disappointing to us that they haven't come out yet in terms of choosing a partner to do it, actually going through the process, but it's coming. Inside, we laugh a little bit because we say that all the time, but it gets a point where India truly needs these locomotives. They need them today, and they will have to make a decision. Bombardier is very well placed to participate in that. André talked about monorail in developing market, but monorail is also delivering a complete system, and we're very well positioned to deliver a complete system, and our monorail that we have redesigned essentially delivers the capacity of what a metro can deliver in terms of passenger per hour, which is a unique product, because one of the concern I have when you think of monorail is that you'll think of the Vegas product or you'll think of the Disney World product. This is not the monorail that we're delivering in Brazil. We've redesigned this product so it becomes a mass transit product. And in country where traffic is already a huge challenge and they want these systems in place rapidly, a metro is not the right solution. The monorail is and will be uniquely positioned, and I think Latin America represents a huge market. Rail control solution. André mentioned that we're the leader in ERTMS in China. This is huge. In implementing a standard in China with a partner that the Chinese are comfortable with, Bombardier, I think represents a huge opportunity for us. So if we look at this is our business so far in all of across the world. But if we look at what we've done in BRIC countries in the last 5 years, we've moved our business from 300 million to 2 billion. So if I apply a view of these markets, just I think in a very conservative way, in the next 5 years, kind of not counting the new airplanes of Bombardier, because as you know, some of these planes are coming in the next 2-3 years, but as they take volume, it takes a little bit more time. But if you just apply the economic growth in those countries, and you're a little bit more aggressive, but not as successful as we have been in the last 5 years, just to be conservative, that at least represents 2 billion growth for us in the next 5 years. So significant opportunity. So if we put all of this together, in the next slide, first of all, from a profitability perspective, I spoke about that slide this morning, but what does that represent? It represents, well, first, before we talk about the volume, I want to talk a little bit about the margin. From a profitability perspective, of course, revenue will influence the profitability, but also we need to continue to improve margin. Where is it in transport? One more percent point to get to 8%, and we think the opportunity beyond that is 1 to 2% additional. We talked about projects today, and I don't want to say this is exactly the target we're going to give. Maybe we're going to be a little bit more conservative in our target, but when we see all the projects that we execute, and André said, you know, the 3 projects we spoke about were not the only challenges we had in executing through the years. We have good projects, we have some that are on target, and some that are more difficult. But as we see our business overall, we think that if we can continue to improve execution, we can get a couple points of margins over time. The other one is aerospace. We truly believe that the 10% is there. Whether it comes exactly when we have given the target at this point, you know, the economy has to give us a little bit of a chance. We need a little bit of tailwind. We need a little bit of volume. But there is a 5% of margin available in transport in aerospace with a little bit of volume and some help from the economy. So overall, if you look at all of this, and I'll put it all together, and if you focus on our 3 strategies, new product investment, aggressive new product investment in both groups, and the fact that we're good in emerging markets and we become local player when we develop our business in local market. Beyond 5 years, and I don't want to give you an exact year right now, but beyond 5 years, that represents an additional business for Bombardier, 10 to 16 billion. That means doubling the Bombardier business. And it's not that I'm saying that without doing the investment. During the downturn, you know all the investments that we're doing in all of our product line. So the growth in revenue, we feel pretty good about it because we're doing the investment to deliver that. And in terms of margin, we see the margin improvement for the company. As you know, we're at 6.5% so far this year. We see the potential of margin improvement of the company from 1 to 3%. So that's essentially a macro view of where we're going, and sometimes it's important to take a look a little bit longer because you see all the investment today, you see the challenges it gives us in terms of cash flow in challenging economic time, But we're doing that for a reason, because we want to position this company to be a significantly different company beyond 5 years from now. So on this, I would be very happy to answer questions that you may not have asked to our three speakers before me.
We have a question. Here's Sinead.
Thank you very much, and that's very helpful to encapsulate all that in your next 5-year plan. So thank you very much for that. My question is, you have a significant amount of new revenue coming in on a brand new product that is a C-Series. What I guess you're implying there is that you are going to see margin lift from that new revenue opportunity, which indicates to me that you're looking at north of 10% margins for your C-Series project. Is that right?
No, what I'm saying is that aerospace together can deliver 10%.
So yeah, that's what I mean. With such a big revenue addition, if it's not at 10% or perhaps above, it would weigh you down below that 10% range, would it not?
Well,
if you're guiding
the
10%
C-Series is going to have to carry its weight in terms of margin. Now, this is a very large program. We don't do program accounting, as you know, so it will take some time. And I do expect initially it'll put pressure on the margin, because we're not gonna average everything to look forward. But that for me should not be significant from an investor perspective. It's more where the product is going, and it will have to contribute significantly to reach the 10%. I agree with you.
Could you also tell us what the range is at the driver, where you said it was a $5 to $8 billion, $5 to $8 billion in? Is it the market share that is causing that range? Is it pricing? Is it a bit of both? What's constituting that $5 to $8 billion?
It's all of the above. You need some volume, and I think we're conservative in the volume. You need, and Guy addressed it a little bit, is that I think we could be more aggressive in terms of putting orders on the backlog. But there's only so many we want as launch orders. Our airplane hasn't flown yet. We're not Airbus or Boeing, where you can demonstrate that you've flown the 737 and the 320, or the reputation is not to be made in these aircraft. So customers, to take a bet on you, they want some launch price, which are going to be quite aggressive. And some of them tell you the tax that they impose to you. I call them tax for being a paper airplane, for not being hardware they can touch. And as we accomplish milestone, we take those tax away. So actually, the way it works with a customer is he gives you a price that they're prepared to pay for the airplane. Usually that's a price that's aligned or above our business plan. And then they say, well, you haven't flown yet. You'll be late like Boeing. We call that the Boeing tax. And so on and so forth. And then we get to a price which is acceptable to us and in line with our business plan for a certain amount of launch customer. So Guy, there's a battle there where we look with our sales force, say, you know what, if we can wait, let's wait. Get enough so we're comfortable. Then we'll first fly, and then we'll be able to talk about another level of pricing. Because in reality, we want to bring the profitability to the C-Series as soon as possible. And if I sell hundreds and hundreds of airplanes at launch price, it's not good for the investor. So step by step is the right way to do an airplane program.
And is that 5 to 8 then a progressive step in annual revenue?
Well, of course it will be
Yeah?
progressive,
Okay.
and it won't be 5 the first year.
Right. Okay. Thank you very much.
Maybe that's another point I want to mention. We need to be conservative in the volume the first few years. If we get carried away, we're going to take too much balance sheet risk, and we don't want to do that. And when I say balance sheet risk is, of course, our airplanes will have no rework, and that's our plan. But, this stuff can happen. And if we get encouraged at this point to ramp up too fast, this could affect the profitability of our company and the C-Series for the long term. So this is a long-term business. Initially, we need to be conservative.
Joe? And David after.
Hi, Pierre. Just a couple things. First, on the IRR issue, I thought that is a reasonable question, and I guess my response to what you said is that would be that if I'm buying the stock today, what return should I expect on my equity over the long haul? Is it a single-digit return? Is it a double-digit return? So I mean, that would be my pushback on it.
And I didn't want to give the impression that it was not a reasonable question. I think if we give you IRR based on the return for your investment, that's a different question, and that's something that we're looking at total shareholder return compared to our competitor, compared to people in the industry. These are all kinds of things we're looking at now that I think would help you. I was responding to IRR project by project. Yeah. I think this is more difficult for you to use. It's not unreasonable to want to know, but it's more difficult to use. So that's a very important point that we're working on.
Okay. The second part of this, and this is a question I asked you, I think, last year at the similar forum, and now you've laid out this 5+ year plan in terms of the earnings opportunity. You're heavily investing right now in your products, particularly in the aerospace business. What's your vision for the company as you get through the major investments here and you get to the point where you're generating a lot of cash? Is your vision that this can be a company that can return a chunk of that to shareholders every year with a dividend and maybe share a purchase and return that? Is your vision that this is a company that grows over time and it expands into another business? I know it's looking far ahead, but you gave us your 5-year plan here, so how about in other aspects?
Yeah, and that's a very good question. First of all, I'll look back to look forward with you. I think after 2002, we stopped the investment at aerospace, not because that was the right thing to do. This is what we had to do for the reasons that you know. And that gave us kind of a balloon that built up, and now we're going through this in the sense that we're investing more than we will in normal years. And right now we're discussing what is that right balance. Before I release it, we need to get to an agreement inside that has to be reasonable so that the shareholder can get a return. I don't want to say about the form. Is it dividend? Is it other form? But I think it's very important in our plan that our shareholder get a good return through time. So by rebalancing the amount of investment, that's really related to aerospace, because in transport it's a lot more reasonable as you compare it to profitability. And that's it's nowhere near the volumes that we're doing today, but it's got to be at a level that we don't end up with a situation like we have today, because we stopped it for 4 or 5 years where the cash flow was good, but in the end we were depleting our product competitiveness. So this balance is a very important debate we're having with our board right now, and then say what are the targets we need to establish from a share perspective, total shareholder return, that are reasonable, competitive, ahead of our peers, and from there, what are the elements that we need to deliver on to give that shareholder return, which is part of return, I can use this term, is part of it.
David number 1. He's your twin, but he's taller.
Okay. Just wanted to clarify a couple of numbers you threw out here. The Bombardier Transportation, the 1 to 2% margin increase, is that over and above the 8%?
Well, first let's get to the 8%. I'm telling you the potential that we see. I'm not sure that we're able to deliver that whole potential to the bottom line. So let's start from where we are today. We're already confirmed one of those 2%. And then we look at get an additional one. They may be more in execution. I just want to make sure and be realistic about the fact that, we'll be much better in execution, but there will be challenges through the project. So that gives you kind of an idea of what we have in mind.
So sort of striving to 9, and if you can get better, then great. Is that the way to think about it?
I look at Andre, and he's just shaking his head saying yes.
Okay. And then on the emerging markets, I wasn't entirely...
Well, I just want to respond to this. And Andre, I think, has done an excellent job at this. It's about delivering profitability on a constant basis. So in transport sometimes, and we've asked about the projects that we have some challenge with, in transport you could go to 10, 11, but then you have to adjust. We manage a big portfolio of projects, and we need to be realistic about which ones when we release a margin, we need to be realistic about is it a margin we feel comfortable with, and deliver profitability you can count on year after year. And that's really our focus.
Okay, that's fair. And then just on the emerging markets, I wasn't clear the 1 to 2 billion, I guess it is extra. Is that from both transport and aerospace, or just transport?
Yeah, this I tried to give you more of a macro view, and this is the next 5 years. Both of them, I think it's conservative. All I did there is we took the economic growth in those countries. We said we're going to do better than this. Let's put it at 15%. That looked like a 2 billion opportunity. Then we compared it to the amount of projects we're working on and which one are growing, which kind of airplane projects we're going after, and we said that's a reasonable amount. But I think there's huge potential, particularly in aerospace, because we haven't done that much in emerging countries. In transport, I think there's huge opportunity, but we've been more successful.
Okay, and then on the 1 to 3%, is that additional margin? So you're talking about you're around 6.5 this year. So you're looking to add 1 to 3% in the next 5 years, in the next year? Or?
Well, I'm combining the target of 10 for aerospace, which I think is reasonable, and the 8% of transport. You see the math there. Now, we'll give you guidance on aerospace in Q4. But in the end, when you think of aerospace at 240 units, I think Guy's team has done a great job at delivering a good level of profit. He will need a little bit more volume to improve profitability. And mix has a large play in it, of course, also.
And then just one last comment, just on the IRR comment. When you're thinking about it,
question too,
that was one.
Okay.
Split by 4.
I'd like to make the comment. When you're thinking about the IRR and you're thinking about what you're going to talk about, it would be very helpful as an analyst to think of this from, and I've always thought this, from a segment context. It's hard to really, a lot of us want to be able to understand your company from the sum of the parts. But we don't really know, because we can't really tell how much invested capital is involved in the parts the way it is. So when you're thinking about what you're going to say about investment, fine, don't do it by program, but maybe by segment would be very helpful.
Yeah, I think it's a segment and a company view, how we do it, and what's this measure. I want to be able to follow it from where we've picked a point to give you an information, and then relate it to the other disclosure that we do, because the next question is, but if you promise this IRR, what about, how do you work this with your profitability? What about so we need to make sure that we can measure it month to month. We measure it internally, but from a disclosure perspective.
David, before we go to David, I have one from the web. It's from André Ramos, and he's asking, are you looking at listing your shares on the New York Stock Exchange in the future, Pierre?
We've looked at it for the short term. In the short term, we don't think that's the right thing to do. In the medium term, given the growth of our company, that's something we're looking at seriously. Now we're in IFRS, so it's easier to do than changing GAAP. We think the right time to do it is when you truly have a momentum, a positive momentum, because what you're doing, I guess the analogy that I could do is that you're moving from a very busy retail street to a much bigger retail street where your window is bigger. So when you present your company, it's better to do it when you've got a little bit of momentum, i.e. the C-Series and so on. That's clearer from a delivery perspective or whatever. I'm not saying that we're going to do it, but it's something a company our size should consider. We've measured Canadian companies that have listing in both sides. There's not necessarily a clear story that it makes a huge difference, but it's something that definitely it's possible to do, and I think in the future of Bombardier it would make sense.
Pierre, that's along the same lines as the question I was going to ask, ROIC and the dual listing. I mean, you've done a lot to rebuild the company over the last 5 years, the last 10 years. Obviously, transparency, the accounting, et cetera, has been much better. Going forward, you're still sort of lagging your peers on the share price. How do you close that gap? I know some of it might be related to legacy issues for a better lack of a better word. But how do you close that gap to get a better realization on your share price, at least in line with your competitors?
Yeah, and that's something we wonder also sometimes, but I think I'll give you my view on this. First of all, we've been focusing, like you say, on giving transparency and building credibility of our team, making our team available so that you can ask the questions and get the answers you're looking for, and really understand how we manage our business day to day, giving you more view on our execution, our capability to deliver constant results. The second thing that I must recognize is that we've taken large bets, like the C-Series, and I can understand that some investors would say, we want to understand that bet properly. Now, that's a great bet from an investor perspective because it'll make the company a much bigger company and very successful. But I think a difference with some of our competitors today is this is such a big decision for our company. There's a lot of wait and see. But at the same time, as we move in time, we can answer a lot of the questions why the C-Series is building momentum. I mean, I used to have to answer questions on what are you going to do, Bombardier, because the three others that can develop this kind of airplane will develop an all-new airplane and they will kill the C-Series. Well, they have all decided not to build a new airplane. Now, really what puts a smile in my face is now people say, well, now they only remotorize, they'll kill the C-Series. This is the most ridiculous thing I've ever heard. It doesn't even make any sense. In the end, we're going to be the only manufacturer with an all-new airplane, and this was the concern of everyone, and now the others have chosen to remotorize. Short-term for Airbus and Boeing, yes, it gave them momentum. But once the C-Series is delivering, you've got an all-new product that's got a plus 10% advantage, a real product that they can touch against a remotorized product. It gives us a huge advantage. And then remotorizing a regional airplane in 2018, this will be an old airplane by that time. Technology will have moved on. I mean, it's not even worth spending a lot of time on that. It just gives us a huge advantage. So in the end, I think there's some of the concern with the size of the bets that we have made, particularly related to the C-Series. And we just got to continue to do our work, give you transparency, and tell you why the C-Series is a good investment. And I think once we have overcome that with the credibility that we have built and the transparency, I think by delivering constantly over the last few years, we will have convinced a lot of investors.
Do you want to try to broaden your investor base to Europe or the U.S.? Is there anything you can do on that front to sort of like the listing? Once you've executed well, what's the next steps to kind of maybe get the share price realized beyond just a Canadian institutional investor?
Right, and that's a good question that we actually have been doing for the last few years. I don't remember the amount of meetings we've increased, but it's like 4, 5, 6, 10 times more in some occasion. So me and Pierre are spending a lot of time on the road, seeing different kind of investors and telling our story. Guy and Andre also in shows, making ourselves more available. So we realize that's a big part of the role, because even in the U.S., sometimes you get a big story on high-speed train, you get a picture of a Bombardier train, and the name is not even mentioned in the article. And that's not the newspaper that's at fault, it's us. We need to get our story better known. We need to get out there. So, for example, in New York right now, there's a big advertising campaign targeted at investors about Bombardier. So you would say, you're not in consumer product, but we need to get our name better known. Also, we do a lot more roadshows outside of North America and outside of Europe, and we're planning some in the Middle East, we're planning some in Asia. Getting our name out there is important, and our company's got a fantastic reputation. You go to India, people know Bombardier in the trades that we're in, and they think highly of Bombardier. Same thing in China. Now we need to bring that to the investor world.
Thank you. Mike, I think it's a trade-off. We go to lunch or we answer your question.
I'll be short.
Okay, make it short. Yeah.
Just one more question on capital allocations. You mentioned, you had to do a lot of reinvestment after a lack earlier last decade. That you've got the C Series now, the Global 7000, 8000. One program that might be left still for reinvestment is a re-engine of the Q400, or do you focus more on returning capital to shareholders before you look at something like that?
Well, don't get me wrong. We will be developing new airplanes still. And that's because we stopped in 2002 really to do only derivatives, very minor derivatives, because we couldn't do it. But if you want to stay competitive, you've got to, in aerospace, you've got to continue to invest year after year. Do we need to take 3, 4 programs at the same time? No, that's more what I'm saying, is that, it's not like we're doing only the C Series, we're doing the other programs you mentioned at the same time. So more of a balancing and pacing. We've hired a lot of engineers. We're going to want to keep them busy, and we have a lot of ideas, but at the same time, we want to pace it and be more level from year to year. It just makes sense.
Okay, so it's still a step down.
Yeah. Oh, yeah. No, it's going to be a significant step down from where we are right now. This is not a level that we should sustain over the long term.